retailers are going to have a much harder time, taking price from here. I think we're starting to see the consumer push back. We're seeing consumers start to trade down into companies like Walmart. We're starting to go through a discretionary recession across retail. I'll just point out that just traffic across retail has been very, very soft over the past 2 months, and that's always a harbinger of things to come.
Chuck Grom said it yesterday. The senior retail analyst at Gordon Haskett took looking at Home Depot earnings just yesterday. We're looking at Target this morning. Target in a pre-market recovering just a little bit. It was negative by 2 or 3%. This morning, it is just about positive, then turning lower again by 0.83% on Target. Shrink, an industry term. This basically is about whether you have fewer items in stock than your inventory records. And Tom, when we talk about that, we're basically talking about theft.
Yes.
This is what they have to say about theft now. It's going to erode profit by an additional $500 million compared with last year. I have to say, that's real money.
What we do here at Bloomberg Surveillance is rip up the script when we have to. It helps to have a guest who's hugely qualified on this. Jennifer Bartashis joins us to say she's senior packaged food and retail staples analyst, whatever that long title means. All we know is she's extremely experienced at big box retailing, holds court at Bloomberg Intelligence. Jen, I'm not going to mince words about this. I can read the math like you can read the math. Pre-pandemic, Target's net margin was 3.8 cents on the dollar. Let's call it 4 cents on the dollar. Shrink used to be 1.8 cents on the dollar, 2 cents on the dollar. It's now exploded. Is there foundational profit now? Walking out the door is a crime.
Well, that's a great setup for me, Tom, because it is an actual problem across the retail industry, and Target is no exception. So there has been, as the economic times have gotten a little bit tougher, theft goes up. And we've actually even heard Kroger talk about it. And you wouldn't think about theft of fresh meat. But with Target, because they're in that middle range where they have accessible, discretionary items, but at the same time, those staples, they kind of sit right in that sweet spot of, offering everything that customers want, but it makes it very easy for them to take it out of the store as well.
Is this an advantage for online? I mean, is the coast-to-coast tumult here of theft in retail enough to push people further to the digital world?
I think when you're talking about higher-end ticket items, potentially. But if you're talking about your regular run and, somebody needs a bottle of shampoo or they need, a T-shirt, those types of things probably aren't moving as much online as people have been going back into stores and they're picking things up in person. So there's probably a little bit more temptation on lower price items in terms of theft than what would offset by pushing sales online.
Jen, do you expect them to close stores in response?
No, I don't think that they'll close doors. I mean, what retailers do, they've got a whole toolkit of things that they can do to combat shrink. That's things like digital monitoring in terms of video. They have scans that they can do in terms of carts going out the door. So there are a lot of technology solutions to help manage shrink. It just takes time to deploy those and to really utilize them to their full capacity.
How much is this just basically the dominant narrative at a time when there's a very complicated picture underneath that they're trying to perhaps not talk about? In other words, how much of the results really point to just a general weakening in their strategy, in their structure, in their sales that goes beyond something that is very much a policy issue, among other things?
Yeah, I think that Target does have a greater exposure to discretionary spending than some of the other big box retailers, and so there is a concern that the underlying consumer behavior, as it shifts, it has a larger impact on Target. So as we're seeing consumers shift into more consumables, we're seeing them shift away from discretionary because of Target's product mix. That naturally has a much bigger impact on them. And so, the real question when we're talking about earnings today is margin, because all of this conversation about shrink and this conversation about a move away from discretionary really comes down to what's going to happen with margins today.
Do you think that basically they're going to say that margins are going to keep shrinking, not necessarily because of shrink, because of theft and organized crime, but just simply because consumers are pushing back, like Paul Donovan was just calling for?
Well, I think that pressure, the margins are going to stay definitely under pressure. If you look at consensus, they actually are calling for a slight expansion in gross margin, but that really has to do more with internal efficiencies in terms of supply chain and things like that versus the actual product mix that they're selling in stores. So if we get a flat margin, I think we'll be lucky. If it expands, that'll be very positive news. But the current environment would suggest that there might be a contraction.
Putting together Home Depot, putting together just a preliminary look at Target, what is your expectation for Walmart tomorrow and just generally for the retail sales going forward?
Well, for Walmart, you're talking about a company that has been pulling more customers in. When we look at Bloomberg second measure data and we're looking at things like cohort retention and bringing consumers back into stores, Walmart is performing actually quite well. So people who used to shop at Walmart every once in a while seem to be coming back more often. Walmart itself has talked about bringing in higher income households more frequently. So there may be a more positive story behind Walmart tomorrow than we may see with Target today.
Yeah, Jen, I know you don't do buy, hold, sell, but of all of these iconic names of American retailing, which is best positioned for the next 5 years, the next 10 years? I don't mean buy, hold, sell. I mean more like they got a strategy, they got a game plan. Which company is it?
Well, if you talk about the long-term strategy, you have to give Walmart a lot of kudos in that they've got a whole plan around an ecosystem where they're going way beyond retail. They're pulling in things like fintech. They're looking at areas where they can create a whole environment for consumers, whether it's in healthcare, the store experience, online. So when you take all of those things together, I think that creates a very powerful growth story over the next few years.
Jen, wonderful to get your perspective. Thanks for being with us. Jennifer Bartashis there of Bloomberg Intelligence. The stock is just about negative by 0.6%. This theft issue is highly political as well.
Oh, yeah.
The argument on the left will be that we're facing tough economic times. The argument from conservatives is ultimately look at Democratic-led cities and what's happening with some of these thefts which just aren't being prosecuted. These organized groups just going into a store and just cleaning it out and walking out, Tom, without much resistance at all.
I think we talk to our audience and, we let them know what we're doing and, where we're moving, what we're doing. Here's a simple thing. I won't eat on a sidewalk. I will not eat on a sidewalk.
What, in New York?
In New York.
Why is that, TK?
There's been enough incidents which you just described responsibly. It isn't worth the stress.
I might push back a little bit because I eat outside frequently whenever I eat out. And I will just say this, I haven't felt a real increase more broadly in sort of violent crimes or crimes in general. The retail theft is unique, and I think it goes to this sort of organized crime aspect where they send people in who then just clear off the shelves. I've seen it myself. They have bags, and they literally just take things and put it into the bags, and then they leave. And there were police officers once right outside a drugstore that was near me. And I went up to one of the police officers and I said, what are you going to do about that? And he said, we could collar the guy, but it's going to take us, 6 hours of our time. They're going to process him, release him in 24 hours, and he's going to be out there in a week. So it's going to take us off the street. It is something that is fundamentally an issue. I have seen it get better, though. I will say that.
Have you? Based on what?
Based on the fact that everything's now locked up, so...
Well, they're locking up the toothpaste, Bramo.
I know, they're locking up literally everything.
I don't think it's, I'll pick on
pretty...
Mr. Arnault because he's at the top of the food chain, but I don't think in the Bernard Arnault model that there was a locked door to get into one of his stores 40 years ago when he was inventing LVMH. I mean, they unlock the door to let you in. They lock the door after you've gone in. You do what you do, which is usually just look because it's so damn expensive, and then they unlock the door to let you out again.
Is that coming to a CVS near you?
Yeah, they're not teaching that. They're not teaching that at retail up at Syracuse.
I don't think so.
These are sensitive issues. I do take your point, Lisa. There's a partition here between an analysis of restaurants and retail. I do agree. There's a distinction there.
You're not the only one that feels unsafe. Let me put it that way.
Yeah,
I
think what Target's done here, this is gonna reverberate in this morning throughout all of retail America.
Amy Will Silverman coming up on the equity market. Looking forward to that conversation of RBC Capital Markets. Your broader equity market right now on the S&P 500 positive by 0.3%. On the Nasdaq, something similar. No big moves here whatsoever. In the FX market, more euro weakness. I think this is something keeping an eye on, worth keeping an eye on. The euro breaking down to about 108.29, negative 0.3%. We've just had a list of missed data points, German factory orders, ZEW investor confidence out of Germany as well. And at the same time, the US showing some resilience. IP industrial production yesterday, control group, retail sales yesterday too, and some hawkish voices in the mix from the Federal Reserve as well. All of that still to come from New York City for our audience worldwide with Tom Keene, Lisa Rabbits and Jonathan Ferro on Crime Watch in New York.
Please.
We could make a daily segment of it, Bramo.
We really don't.
Bramo's tour of New York.
It would be very different than Tom's.
Things are getting better.
Probably, yeah, they are.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Those recessionary signals are all over the place.
We haven't gotten to the point where people are getting actually nervous.
Markets are expecting a pretty rapid slowing in inflation. Fed officials are a little bit more cautious about that.
The truth about inflation is somewhere between transitory and persistent.
There are parts of the globe where we still have double-digit inflation. So this battle isn't over.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market near session highs, up by 1/3 on the S&P 500. The retailers in focus this morning. Target out with numbers. TJX in just a moment. Then it's on to Walmart tomorrow, Tom Keene, after the disappointment of Home Depot yesterday.
Home Depot disappointment. I'd say that every one of these stories is different. I'm an amateur on this. I conflate them all together. together and someone like Jen Bartusis can just tell us each story's different. I believe she said Walmart's leading the way. So Walmart, particularly after the headlines from Target on theft, Walmart's really important.
Walmart tomorrow, Lisa. Target just about positive in the pre-market right now, up by a little more than 1%.
When you dig under the sales and theft that we were talking about, they do say that softening sales trends are likely to crimp short-term results, but have a more sanguine view longer term. They have been talking about moving away from some of the discretionary items, and this really goes to the point we were talking about yesterday. How much are we seeing a discretionary recession and resilience everywhere else, which makes it very difficult to come up with some sort of clean narrative around all of these stocks.
And how long for the Federal Reserve does it take to go from goods to services, for that to spread?
And that uncertainty you're feeling and that splintering that you've pointed out between some of the Fed officials that we've been hearing from on the margins, talking about what the optimal way forward is, how much they need to keep battling inflation with further rate increases.
But they're data dependent. They're going to get data from Target, data from Walmart, and data we don't even see. And they're going to be after the fact. John, they're not going to act until the vector on service sector inflation is well in place. We're not there yet.
As you know, the problem, they've all got different interpretations of the same data and place different amounts of weights on each
Different
indicators.
amounts of weights. Not so much interpretation, but weights. Yeah, absolutely.
Data dependence just kind of drives me nuts at the moment, as you know. Mohammed Al-Aram was on the program yesterday doing the same thing, basically. He said the same thing. It's just like, you know, this catch-all phrase that is ultimately just meaningless now. We're data dependent.
I was actually
what does that even
wondering.
mean?
So Austin Goolsbee yesterday was saying, you know,
He's
it's
data
too soon.
dependent
He's
too.
data dependent. He said it's too soon to make any call about where I'm going to be at the next meeting. I just have to wait for the data to come in. And I keep thinking to myself, when's the aha moment when we're all like, oh, this is how the market's going to turn?
It is there's no evidence back to Anna Schwartz and Milton Friedman that they get out front of the data set in the monetary politics and theory. They just don't.
They did in 2021 for the whole year.
They were coming out of the pandemic.
Were they data dependent then?
No, they had a theory.
How did that work out?
It worked out great.
Yeah, all right.
They had a theory.
Okay, your equity market's positive by 0.35% on the S&P 500. Yields are just about unchanged, Lisa, on a 10-year. 353.20 on 10s this morning.
All right, we already got Target. We get TJX companies probably around 7:30 in about a half an hour time. We get Walmart and Ross stores tomorrow. It is interesting to see the year-to-date marginal gains on both Target and Walmart.
Nice.
Is this an issue of discretionary spending at Target that is going down and basic staples and people trading down in terms of price for Walmart, boosting what we see tomorrow? That is what I'm watching. 8:30 a.m. Housing starts and building permits for April. Have we seen a bottoming out of the housing market? Because there are signs of stabilization. Yes, mortgages are coming down. We saw that just with the latest U.S. MBA's mortgage applications index, which just came out, declining yet again. And yet there isn't enough housing and people are staying with their living. So, you know, the prices just aren't going down as much as people expect. Yes, Tom?
Same thing in Britain. I mean, there's an article, I think, in the Telegraph, John. It's as simple as this. Mortgage rates are low. People aren't moving out of mortgages. Period.
You know, the story in America, couldn't agree more. Totally on the same page. Anyone that's locked in a 30-year mortgage, we've said this so many times on this program, they're going to hold on to that like their life depends on it. That's the greatest trade they've ever made.
There was a survey yesterday that showed that mobility, the willingness to move for a job, has gone down to the record low level. Because why would people move at a time of remote work, at a time of lack of mortgage flexibility? Let's just finish up with President Biden departing for Alaska and then Hiroshima, Japan, for G7 talks. He is coming back early because he wants to get the debt ceiling finished up, so he's not going to Australia. That's going to be postponed.
The greatest trade ever made, walking into a First Republic, taking a jumbo mortgage, 30 years.
1.50%.
Whatever it was. Whoever did that, you know, right in. Congratulations.
Plus they had deposit insurance on the way out.
Absolutely awesome. With us around a table. Amy Silverman, no idea if you went to First Republic when rates bottomed.
That was me, no.
But great to have you with us.
Yeah, congratulations.
Head of Derivatives Strategy at RBC Capital Markets. You've got a great phrase in your notes, Amy, and wonderful to see you in person, by the way.
Good to see you guys.
You said this, the paddling duck market. What's that?
That's the market we're in right now. I mean, we got this chill, cool duck hanging out on the surface, furiously paddling underneath, and that's the equity volatility bid. You know, we don't see it in VIX. Headline VIX is really low, right? But the reality is VIX call open interest, that demand for volatility going higher, is at all-time highs.
I'm speaking with Nassim Taleb in like 3 or 4 weeks, and we'll go to the tails immediately, and you make it real clear in your note that there's a tail irregularity here. Everybody's focused on the left tail. Tell me about the right tail, the tail of optimism.
Yeah, so the tale of optimism does not exist. You know, I've been visiting kind of clients in Europe and Canada and the US, consensus bearishness across the board. It's really overwhelmingly so. And so you get to this point where you have to ask, you know, the right tail is so underpriced. Is there a possibility of a congressional miracle? Who knows? But right now, folks are pricing that this is going to be a very tumultuous debt ceiling. If it at all comes in a little bit easier than we expect, that right tail is very cheap.
Whoa, this is actually going against the consensus in a big way. People have come on the show again and again and said nobody's pricing actually a debt ceiling debacle where you end up with some sort of default, except perhaps in the 1-month T-bill market. Are you saying that's not true, that it's actually aggressively being priced in the equity world?
Yeah, so here's the nuance, Lisa. What is happening is essentially the volatility market is saying the tail has to wag the dog first, meaning we have to see action in the equity market, which means a drawdown, before we see some sort of action in Congress. Does that mean an actual default? Maybe not, but it's definitely going to be 11th hour, 2011 type style. And if you actually plot the VIX right now against what the VIX looked like in 2011, it was right around here in 2011. And then we saw that it peaked around 50 in August, and it sustainably was above 30. And I think that's what these bets in the market are saying right now. They think we're going to get back there.
I love this idea that the calm in the market is people not willing to make a move by selling what they own, but they're doing it all through derivatives. So based on pairing those two, what is the most underpriced reality right now? Is it this upside surprise, or is it something else?
The most underpriced reality right now is the idea that this debt ceiling situation actually gets resolved quicker and easier than we think. That is not what is being priced in the market. Folks are very, very well prepared for a debacle. And so if we don't get it, it would be very interesting to see all these hedges roll off. You know, that is not being priced.
Sometimes there's a big difference between ideas and execution, and it frustrates people at home. And you speak to those people in the market. If I wanted to position for a so-called up crash, your language, the language other people use as well, before I get the downdraft and the tension, because ultimately we're acknowledging, and you've alluded to it, that you need to get the crisis before you get the solution, or get very close to the crisis before you get the solution. Can you talk to me about how you execute that trade? Do you wait to position to capture that upside when you start to see some of the drama take place, or can you position for it now?
Yeah, you know, and that's the tricky part. I think right now it becomes, look, if we get the drawdown, right, so the market move happens a little bit, then that up crash scenario becomes a little bit more expensive because we've already taken that down hit. So in some ways, you do have to start placing it right now. The good news is it's relatively inexpensive. One of the reasons, and I've been saying this to investors, the reason VIX looks so low isn't because S&P puts are cheap, it's because S&P calls are cheap, and those are both weighted in the VIX. That's part of the reason you see that being subdued. So if you own that right tail, just say owning S&P calls, you know, that's inexpensive right now. And that would happen if, you know, we get closer to that X date and actually there is a resolution. You know, Biden flies home and these folks get actually their feet on the ground and do something. That would be quite interesting.
Every crash in the hindsight is about opacity. I didn't see it coming. It was a mystery. The cliches, the shadows in that. 1987, 1998, et cetera. What's the biggest mystery for you right now? Where's the dearth of information?
To me, the most fragile part of this market, Tom, is this problem of breadth. So one thing I looked at that I think is really interesting is if you just take S&P consensus price target on Apple right now, that Sharpe ratio is negative on Apple, meaning you're actually better off in cash if you assume expected rate of return of the S&P, of the Apple price target, than you are in Apple. The breadth of the market is so heavily weighted and it's very fragile.
Is that Sharpe ratio adjusted because of the velocity of the risk-free rate? You know, we had no risk-free rate for 3 years. We all got old doing it, and pop, there's the risk-free rate tumbling. Do you have an accurate risk-free rate? Do you have a belief institutionally in a risk-free rate forward?
Yeah, so we're assuming a risk-free rate right now of just, you know, what we're getting on cash right now. So obviously that could go down. But if you just take from last year to this year, it going from about 1% to almost 5% across the board. Right. Obviously, all equity Sharpe ratios decline, but also your forward-looking price targets are declining.
I just want to follow up on one thing that you said, where you said it's very fragile because of a very, very narrow depth. How much does that suggest to a downside shock versus an upside shock, or does it not matter? It just suggests there will be a break one way or another and it will be significant.
I think the biggest thing to watch right now is if the market decides that mega cap tech is not a safe haven, because you could actually get financials ripping or industrials ripping and it wouldn't matter. On an S&P level, you could actually see the index level trade down, right? Because the heavyweights are the ones selling off. And that's what I think is very interesting about this market is you could get that turn because maybe recession fears aren't as bad as expected, but the reality is the market's actually selling off.
The action happens beneath the surface. Most crowded trades, B of A, in the survey. What were the indications? Short banks, long tech. Top two trades. Top two trades identified by people in that survey, Tom.
And a lack of breadth is what the phrase I use, choice set. There's no choice set out there now. I couldn't run a prospectus structured institutional portfolio, John, because you have to have X number of ideas in the portfolio, and there's not enough ideas out there right now.
I just think this is fascinating, this idea that you could get a better than expected economic shift, whether it's the debt ceiling or whether it's data, and all of a sudden you end up with index level losses because everyone floods out of the very narrow range of stocks that have really been driving all the gains.
I mean, Amy's with us for the entire hour. We got to talk to her about the scenarios that are coming out of an Ed Hyman 2.8% inflation. No one's prepared for that.
And nobody told Amy about that either.
I can tell by her face.
I'm just trying to suggest it, you know.
Amy, thank you. It's wonderful to see you. Great to see you in person. Amy with Silverman there of RBC Capital Markets. It's like get back to work at Bloomberg Surveillance. People coming back into the studio. This is
great.
Nice.
Love it.
It's wonderful.
This is nice.
It is so good to see everybody.
This is part of our BlackRock sponsorship. Get back to the office 4 days a week. There's no BlackRock sponsorship.
Can we go to 4 days a week?
4 days a week. I wish. I wish. Terry Haynes of Pangea Policy.
He's on 3 days.
On the debt limit negotiations coming up shortly from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy are expressing cautious optimism that they can reach a deal on raising the debt limit. That would potentially avert a catastrophic default. Negotiators want to come up with a framework agreement by the time the president returns from a shortened trip to Asia. Target says that softening sales trends are likely to hurt its short-term results. The discount retailer predicts that earnings in the current quarter will fall short of estimates. Target is standing by its annual profit forecast. It sees consumers buying fewer discretionary goods, things like home furnishings and electronics. In Japan, the economy expanded at a faster rate than expected in the first quarter. Gross domestic product rose at an annualized pace of 1.6%. A further easing of pandemic regulations led to an increase in consumption, and that will likely keep speculation simmering of a possible early election and potential central bank policy change. UBS sees an estimated $34.8 billion gain as a result of its emergency takeover of Credit Suisse. Still, the Swiss bank warns that it faces billions in potential legal and regulatory costs from the rescue of its former rival. UBS stands to benefit from the combined firm's negative goodwill. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Business Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Hi, I'm Francine Lacroix. Join me on Leaders with Lacroix as we explore what drives the most influential people on the planet. Leaders with Lacroix on Bloomberg Television, TV Go, and Bloomberg.com.
The nature of the presidency is addressing many of the critical matters all at once, so I'm confident we're going to continue to make progress toward avoiding default.
The president agreed to appoint a couple people from his administration to sit down and negotiate directly with my team, so I found that to be productive personally. But we've got a lot of work to do in a short amount of time. It is possible to get a deal by the end of the week. It's not that difficult to get to an agreement.
Some constructive language used by President Biden and House Speaker Kevin McCarthy after a second round of high-level talks over the debt ceiling. The staff-level meetings will continue every day, we're told, going into the weekend maybe, and maybe through the weekend, while we wait for the president to get back from his trip to Asia and the G7 in Japan. If you are just tuning in, welcome to the program. The broader equity market, no drama here at all, really, at the moment, up by 0.4% on the S&P. In the FX market, the euro a bit weaker again, 108.33. Yields not doing much, 352.82. Looking at target in the pre-market, just about positive here, Lisa, up a little more than 1% in early trading.
I'm looking through some of the results, and even though the second quarter forecast fell short of estimates, you do see first quarter performance exceeding them and then a better look out further. So that perhaps could be underscoring some of the positive move in the shares.
Not a screaming endorsement of the second quarter, though, exactly, is it?
And normally the shares move on the forward-looking projections, so we're going to dig through and truly understand, as well as what already had been priced into some of those shares.
At TJX a little bit later this morning, Tom. Walmart tomorrow, as you know.
Walmart's a bigger deal in the last 24 hours. After Home Depot, it was a big deal, and now after Target, it's going to be fascinating to see how they address it. I'm really fascinated by the follow-up, John, of the headlines from Target on theft and shrink. I just think every single CEO today is meeting with their teams saying, how do we address this in the manner we want to address it?
You hear it a lot from the CVSs of this world, Tom. Not new, it's been going on for a little while now.
Yeah.
And it's a problem. You're right, it's a problem.
And I just think that it's going to be, it's one of those issues, and maybe it even folds into the politics of the nation as we move to the election of 2024. Right now, that's out there somewhere. What's more immediate is the debt issue. And John, you know, it's the goalposts. Is that the cliche? I'm thinking of Inter Milan.
You can say that, yeah.
I'm thinking of Inter Milan and AC
Milan
and the goalposts. Okay. Can we get a partial score up on the game yesterday?
Can we not?
This is George Carlin.
Can we not?
There it is. Partial score. Inter Milan won.
This is cruel.
And we'll leave it at that. They moved the goalposts yesterday in Milan, and then maybe they're moving the goalposts in the debt ceiling crisis.
Better team won. Greater intensity. I was there last week.
The intensity.
I could feel it from Inter. Even when they were the away team last week, just the better team won.
So what do they do now?
Good luck to them. They're going to play what will be the favourite, which is the other half of the final, which comes out of Manchester City or Real Madrid
today,
later on this evening. This afternoon.
Big game.
Massive game. And I think the overwhelming favourite will come out of that leg, come out of that time. We'll see what happens. Let's talk about the debt ceiling and not my beloved AC Milan. Terry Haynes of Pangea Policy weighing in on debt ceiling talks. I'd rather watch them than Milan at the moment.
Oh, that's not exaggerating.
I know. There's still a 40% possibility of default. Base case, the deal gets done. But there's a large possibility of catastrophic mistakes. There was one. And it gets more stubbornly large the longer the impasse continues.
It will be interesting to see. Joining us now with his update, his treatment of this is Terry Haynes with terrific Capitol Hill structure and the tapestry of history at Oberlin College. Terry, you're a great student of this, and you know things get done in offices. You and I were talking about Harry Truman over a bourbon with Sam Rayburn, figuring out he's president after the loss of FDR. Okay, great. What's going on in those hallowed offices right now?
Good morning, and thank you for having me on CSI Midtown and Football Report. What's going on right now is a couple of things. One is, you've got staff from the president. Terrific staff, by the way. Steve Ricchetti, exactly the right guy to try to move things forward, and a member team led by Garrett Graves of Louisiana, kind of gearing up to try to figure out how to try to put together a framework. First of all, I mean, I've been hammering for a while that there is no framework, and that turns out to be true. To try to come up with a framework and then try to put some meat on those particular bones in time for the president to come back on Sunday. So I think what you're going to get is you're going to get a muddle from Washington over the next few days as they try to do that, number one. Number two, I think what you're going to end up with is some kind of framework that, as I think a lot of people in Washington expect anyway, that includes both some sort of debt ceiling increase or suspension, probably an increase, for a period of time, and then some general idea of what the spending cuts are going to be. And then they start talking about whatever the details are, probably in time for Biden to return. So, you know, there's not going to be a solution here in the next few days, to make a long story short.
Terry, you've lived this. Do the politicians listen to their staff?
They listen to them, yeah, but I think anybody that tells you that staff is somehow running the game here is completely missing the boat. There are two kinds of people in Washington that will tell you that staff are all important. One are former staffers, and the second are journalists who rely on current and former staffers to try to come up with these things. You know, my response to people always was and always is, do you have a badge, lapel badge? Do you have a voting card, which you can take a vote? Those are the important people. Everybody else is ancillary. So what you got here is a situation where you're going to have staff try to work through this stuff for the next couple of days, but the principals still have to come together, and that hasn't happened yet, really.
How big of a deal was it that Kevin McCarthy yesterday said it is possible to get a deal by the end of the week? It's not that difficult to get an agreement, after basically saying that both sides were dug in and it seemed impossible a couple days earlier.
Well, I think both of those things are true, Lisa. It's not that difficult to get an agreement if the other side capitulates, right? That's always true, number one. Number two, you know, I think the difficulty here is going to be on the Democratic side in the next few days, because it is going to start dawning on people, and it probably already has started, I think, that what Biden and Democrats wanted originally, which was a debt limit, you know, with no conditions, is something that's not going to happen. There's going to end up needing to be a bipartisan solution that includes some sort of spending cap or spending break, and you know, it is up to White House staff to start breaking that difficult news to a lot of Democrats. And you're going to see a lot of those Democrats get real squirrely over the next few days.
We were just speaking with Amy Wu Silverman of RBC Capital, and she was saying that the market is positioned under the hood, perhaps, for this to go up to the end, perhaps even breach it, create a whole host of volatility, which then will actually force people to come to the table. Is that still the most likely outcome to you, or have you shifted based on what you've heard in the rhetoric recently?
Well, you know, what I've always thought is, you all put my position out there entirely accurately. I'm still 60%. I think this thing gets done. But what ends up happening, I think, the most likely scenario is that we come kind of right up to the X date. There is some framework for agreement. The principals will still be in the middle of trying to convince the various votes to get there and actually vote in favor of the thing. And then, you know, you get, like you get with a lot of spending bills in the fall, you get temporary extensions. So somebody's going to say at some point, look, we have enough faith in this, and we're all kind of, hands together, and we're taking the leap together. So, so let's do a 7-day debt ceiling extension or something to get us through that. I see that as a much more likely scenario, a much more likely process for the way that this thing rolls out.
Thanks for joining CSI and the Sports Show this morning, Terry. We appreciate it. Terry Haynes there of Pangea Policy. A bit more sport for you, actually, a headline. There was due to be a race in Emilia-Romagna in the northern region of Italy. The Formula One race, Imola, has been cancelled after the floods in the north of the country. Tom, this stretches out to Venice as well. We've seen thousands evacuated across the north of Italy. Unsurprising, perhaps, because some people were pushing for this. So that's the Imola Formula One Grand Prix cancelled after those floods in Italy. I believe the next round is in Monaco.
And it involves
the
death
weekend
and
after.
destruction. This is serious stuff.
Of
There's
course.
already 5 dead, and many thousands of people have had their lives adjusted. And to Venice, and you know, it's a romance of engineering. How do you keep the Adriatic Sea out when it misbehaves? And they have barriers, which I'm going to say have been politely a 30-year project of failure and success and failure. And I guess they're literally activating them today.
Yeah, and Tom, as you know, the logistics effort around any F1 race is huge. Humongous.
Yeah, well,
So unsurprising.
It sounds like an intelligent decision.
Unsurprising that has been cancelled. Any more information on that, and of course on the floods in Italy, we'll keep you up to speed. From New York, Mike Schumacher of Wells Fargo is going to join us shortly. Looking forward to that. The equity market positive 0.36% on the S&P. From New York, this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
2 hours away from the opening bell. Let's get you some price action on the S&P 500, positive by 0.3%. On the NASDAQ, positive also up by 0.2%. A nice banking story out there this morning for Western Alliance. Lisa will no doubt bring that up in just a moment. In the bond market, 2-year, 10-year, 30-year looks a little something like this. Unchanged on a 2-year, 4.0739%. On a 10-year, 352.45. Shift higher across the whole curve yesterday, particularly at the front end, led by the data, throwing some hawkish Fed speak and a sprinkle, I'd rather say, a chunky debt issue from the likes of Pfizer, pushing yields higher. In the FX market, bit of euro weakness out there for you. The euro against the dollar, euro-dollar negative by 0.2% at 108.38. If you're starved of Fed speak, I don't know how you could be, but tomorrow you'll get the likes of Jefferson, then Barr, then Logan, then Williams, Bowman, and Powell to round out things on Friday. Chairman Powell has got to get a hold of that narrative, TK, this week.
I strongly agree with that. And, you know, in his defense, it's not his fault. Everybody but him is talking. And, hey, I'm sorry, he's the one that matters, I believe, unless you want to...
We hope.
On that, but it's...
Should be.
I'd love to talk to McKee about this. He's too busy listening to these people.
Chairman Powell Bramo on Friday.
Too busy listening to these people,
and
really?
speaking to them.
That's literally his job, and we listen to it, and we also glean some things from them.
What is the value add of 15 presidents talking versus 30 years ago, where there was a collegial science? You know, they talked to Chamber. They went to a Rotary meeting in Little Rock. And, you know, you took notes.
Well, we all pay attention. And the reason why is because it gives some sense of perhaps which data is really remaining supreme in their views. And we can discuss this. But I do read it and I do listen to it. And Mike, thank you for all that you do. I just want to say,
back in the day, they didn't have the role they have now in the economy. The economy over the last several decades, TK, as you know, has become so highly financialized over the last few decades. So the role of any given one Fed speaker, they ultimately have more power. Now, this might be controversial to some, but I think you can make the argument to some degree over the economy, they have more power over elected officials in Washington.
Did you see Mike Pence's basically election slogan yesterday? He came out, rein in the Fed. He basically is saying that they should have one mandate. It should be inflation, and that's it, and take out the other mandate. So you're not alone. There is a school of thought. I would say that at a very complicated economic moment, it's actually nice to get the nuance in each speech, and I've been enjoying it. And Mike, thank you again for all of your work. I do want to give some specific names, and we have been talking about the retailers. Target coming out earlier, those shares managing basically a 0.2% gain. I was digging through some of the data, and it shows that if you take out shrink, I don't want to talk about the sales and the theft issue just now, and you take out some of the other trends, what you see is sales of food and beverage, household essentials, and beauty all remain strong. And get this, profits got a boost from lower freight costs, higher product prices, fewer discounts, and fewer digital sales. Basically, they were able to expand their margins in other areas because they could pass along the price increases. This is what we were talking about with Paul Donovan. TJX is supposed to come out any minute now. We are waiting for those results, but basically trading up, perhaps in sympathy, up 0.5%. And Walmart set to do report earnings tomorrow. We did mention the banks. This, to me, is interesting.
It's good news.
Well, it's good news for Western Alliance, seeing $2 billion of inflows over the past week. PacWest also up about 9%, a bit more than that. Is PacWest the same as Western Alliance? And here's the question. They were also in hearings yesterday, and they blamed the failure of some of the other banks on some of their issues, and we heard this from First Republic as well. I'm just wondering how much people are drawing a distinction between the banks versus just wholesale changing their opinion based on the sentiment shifts that seem to move like the tides of the ocean.
Well, there's something fundamental there. Deposits are rising. That's good. Whether you can make the case that there is some kind of story here that you want to get constructive about and get long and take a position in the equity market, not for me to say. But I think if deposits are moving in that direction, which is the right direction for the institution, that's good news.
The interesting factor is that everything seems to move in tandem, though. If Western Alliance goes up, PacWest is also going up. So, you know, again, are these specific stories, or is this something that they all collectively have to show in order to get some real move toward them?
Janet Front on TJX, we're making jokes about it, and they're out front here on shrink. This is in our note before the earnings announcement from TJX, that they've been very clear about this issue. You know, maybe you're
That's a major issue.
This is like a major issue as well. I mean, it just folds into the times that we're in.
When we get those numbers in just a moment, Bramo's going to break them down. She can't wait. Can't wait to talk about this either. Debt limit talks between President Biden and congressional leaders intensifying. Mike Schumacher of Wells Fargo and the team have got this to say at the moment. Our economics team is skeptical that a sweeping debt ceiling agreement will be reached over the next month to suspend the debt ceiling for 1 to 2 years. A short-term punt, Tom, I think that's a kick the can, that buys more time for an eventual sweeping agreement is the higher probability outcome. in their view. Shorter version, TK, we're going to be playing this game for a while, maybe.
Yeah, we're going to have to see a punt there, John. It's American football. That's when you're down 3 downs and the 4th down you can't.
Is that the guy that comes on just to kick the ball?
Just to kick the ball high up. And
what a
sort
job
of
that might
rugby-like.
be.
They used to have a rule he could be hit by the people coming in, but now they have rules to protect him.
Okay, so literally the only thing he's good at is just kicking the ball.
Yeah.
Nice.
The punter, we call that.
Generally, goalkeepers would love that job.
They would.
Ex-Premier League goalkeepers would find that so easy.
It's a CIS sports report. It continues in this block as well. Saving us right now, Michael Schumacher joins us, Global Head of Macro Strategy at Wells Fargo. The courage is defined in your research note, Mike, is that you are long duration. You're saying get out there, own bonds, yields will move lower. Discuss, given the debt ballet in Washington.
Yeah, the debt ceiling, Tom, it's tiresome, but it's not going away quickly in our view. And we still look for the market to panic a bit more. It's interesting. You can talk about the market, but it's really the markets here. So the Treasury bill market's in full-throated panic mode right now. You've got yields on May bills that are low 3s, yields on June bills that are, call it medium 5s, so an enormous gap there. But Treasury bonds, 10-year Treasury, 350 neighborhood, it's been there for a while. The equity market's sort of plugging along. Foreign exchange is puzzling to us. We think the yen should be a big beneficiary. And oh, by the way, implied volatilities for currencies are low. So it seems like the Treasury bill market at this point is the only one that's really panicking, and the rest are saying, it'll get worked out, don't sweat it.
What on a year basis is long duration? Is long duration 5 years, or is it 12 years, or dare I say it's an Austrian pre-sought 50 years? What's long duration?
No, we're not going Austrian here. Let's keep it to call it the 10-year. And the reason I say that, certainly it's the benchmark, but when people want to move a lot of risk globally, that's where they go. They go to the 10-year part of the U.S. curve pretty consistently, tons of liquidity. So you want to think about some numbers, 352 and change on the 10-year yield right now. If things go really badly, if Thelma and Louise can't figure out quite where the cliff is and go over it, maybe you're looking at 3%, something like that. I certainly hope it doesn't happen, but it seems like it's pretty low cost right now to insure against that risk.
I keep thinking about this paddling duck market that Amy Silverman was talking about, because it seems very difficult to get our hands around with respect to the debt ceiling and then some of these company profits that are coming out, these company earnings that are coming out. And as we get retail sales, I'm wondering if you could weigh in on Paul Donovan's point that companies are really expanding their profit margins and consumers are only just now starting to push back, and that's a significant driver of inflation. How much is that really what you're seeing as well?
Yeah, it's really interesting, Lisa, and we characterize inflation right now as stubborn globally. You think about it, country after country. Canadian data came in high yesterday. Recently, Australia hiked, surprised the markets. You look at the UK, inflation data are pretty unpleasant, especially on the wage side. In the US, I'd make a similar argument. So, yes, inflation's come down. Has it come down nearly as quickly as the central bankers would like to see? No. And I think that's to your point that you still have pricing pressure for a lot of companies. What does it mean for markets? Means a lot of these rate cuts get priced out. And maybe some of the central banks have another hike. Maybe you see a few more surprises. But the idea of a lot of rate cuts doesn't make sense to us. Now, I just said get long duration. It flies in the face of that argument. But it's really a timing thing. Long duration until the debt ceiling is resolved. Then you focus much more on inflation.
How much should you actually just go into some of these companies, though, with pricing power? If they're able to expand their margins, it doesn't really matter a lot of the other potential issues, because they're still able to make bank because consumers aren't pushing back that much.
I'm going to leave the earnings discussion to my colleague Chris Harvey, but when you think about it from a macro perspective, it does point to more inflation as far as we're concerned. That's the big takeaway I've been focusing on recently.
I look, Mike, at where we are in May, and what it just simply comes down to is we're all baffled in a tight collared range. How do you know when the collar's over in which way a given vector goes? What's your experience on that?
Yeah, we can see gappy types of moves, Tom. We've seen it a few times this year, certainly around the Silicon Valley Bank. And I'll give you an example. So dollar yen was 136,
yep, exactly.
137, something like that on March 8th. Call it, went to 130. So call it a 4 to 5% move. That's a big move. Not as big as the types of move we had last year, but they were more secular. But something like that happens in a week or two in a super liquid market, that tells me we've hit the boiling point. We're not there yet. I think it could happen. I think those price points are probably about right. And so debt ceiling goes really astray. Yen moves another 5%, strengthening versus the dollar. That's the kind of thing I look at.
Finally got those results from TJX. Let's get to them. Mike Schumacher, thank you, sir. As always, on a bond market from Wells Fargo. Mike Schumacher there. TJX in the pre-market is negative 1.4%. This is the first quarter performance, and then we'll talk about the second quarter and full year outlook as well. The first quarter comp sales come in at 3% positive, the estimate 3.1%, so largely in line there. The full year outlook for both sales and for EPS as well. So let's do sales first. Still sees full year comp sales at 2% positive to 3% positive. The estimate there was 3.31% positive. Full year adjusted EPS, a range here of 339 to 348. They had seen 329 to 341. Some details there, Bramo, on margins as well.
This really goes to the same story. The actual sales on a comparable store basis are going down, but they are able to pass along the price increases and then some with profit margins that are expanding, and with input prices that have come down in certain areas that they then can capture the difference. So basically, companies keep increasing the prices well beyond what their base costs are, and this is the reason why it can support their earnings per share, even if the actual sales volume starts falling even more.
Initial reaction, Tom, in the early part of the session this morning in the pre-market, we're down here by 1.9%.
They're all the same. No, they're not. The net margin and the shrink question we talked about with Target was 3.8% pre-pandemic. John, TJX, a profit machine. We make jokes about it, but this has been a profit machine for decades. Double the net margin. They're working in 2019 with a 6.9% net margin, double what Target's doing.
That's TJX down in the pre-market, negative 1.9%. Target behind us, Walmart still in front of us. Those numbers will come out tomorrow. Still to come, 8:30 Eastern time, we'll catch up with the brilliant Mike Gapin of Bank of America. In just a moment, we'll try and catch up with Shanali. Looking forward to this conversation. BlackRock says get back to work.
She's working from home today?
Get to the office. I hope she's in.
I hope she's. I don't know.
In fact, maybe it'll be better TV, radio if she's
She works from home like 6 days a week.
I think she's here from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. A smaller group of negotiators will head back to the table to hammer out details on the debt limit after President Biden and congressional leaders failed to come up with an agreement to avoid a default. Biden leaves today for a Group of 7 meeting in Japan and says he hopes to resume talks when he is back in the country next week. The president and lawmakers say they're hopeful the negotiating teams can find a bipartisan middle ground. Former Vice President Mike Pence is calling for an end to the Fed's dual mandate. He says the central bank should focus only on inflation, on fighting inflation, and leave job creation to Congress and the president. Pence told Bloomberg the Fed should return to its historic mission of ensuring sound monetary policy. He's considering challenging Donald Trump for the Republican nomination next year. Bank of England Governor Andrew Bailey says he is unwavering in his commitment to the UK's 2% inflation target. At the same time, he's warning that higher food prices and a tight labor market could cause the cost of living crunch to persist. Bailey spoke at the global annual conference of the British Chambers of Commerce. It's a major shift for a company that has largely avoided traditional marketing. Tesla CEO Elon Musk says the electric car maker will dabble in advertisements. At the company's annual shareholder meeting, Musk said, quote, "We'll try a little advertising and see how it goes." Tesla has long relied on word of mouth to market its cars. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence. for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
To cooperate with the regulators as they do.
Are you planning to return a single nickel to what you cost the fund?
Senator, I know there's going to be a process review of compensation.
I'll take that as a no. So you're planning to return how much?
The answer is
none. That's
I
it?
am not planning to do so, no.
Another productive hearing on Capitol Hill. Senator Warren grilling former Silicon Valley Bank CEO Greg Becker, former Signature Bank Chairman Scott Shea. TK, what do you make of this one?
What I make of it is rare to have politicians that have a domain knowledge and a wheelhouse ability in a certain place. This is where Senator Warren is most comfortable. Out of the University of Houston, she was truly definitive on bankruptcy law and the study of business collapse in America. So when she opens her mouth on this, it's like Paul Krugman on international trade. Take notes.
That specifically, though, was just a YouTube clip for the next campaign, wasn't it?
Led by someone with domain knowledge about the history of this.
That I'm not disagreeing.
Unlike some.
How do you make these hearings actually productive, Tom?
We call that the United Kingdom. We don't do that. We don't do that. That's the grandstanding of it. You know, there's no other way to put it.
Bramo, is it anything more than grandstanding?
I hope that there are ongoing hearings today in the House. I'm guessing it's a lot of grandstanding, which perhaps masks real policy shifts that could be discussed that are much more controversial about how to create perhaps a better landscape for the regional banks that do account for an outsized amount of lending.
The next steps, what do they look like? These are the next steps on Wall Street and beyond. BlackRock have this to say: get back to the office at least 4 days a week. Right. I love the happy talk from corporate executives on this stuff. Career development happens in teaching moments between team members. It's accelerated during market-moving moments when we step up and get into the mix. All of this requires us to be together in the office. Tom, you love it as much as I do.
On behalf of John and Lisa, the team effort to get the three of us back in the building in the heart of the pandemic was really something. It was really something to behold. This involved, I'll say, 40 people top to bottom and some serious worry about the illness. We lived this in real time. Now everybody's climbing on board, and it was a language derby yesterday. The calls to come back, the pushes to come back, the orders to come back, work from office. Senior correspondent Janelle Bassick joins us right now. Is this a sea change in BlackRock?
No, I was surprised to see the memo, to be honest, because it's surprising that people are not coming back. Remember, activity is coming back on Wall Street, and these businesses are changing massively. And when you look at BlackRock in particular, they just spent a whole lot of money revamping offices in Hudson Yards. Of course, they want people back.
We've seen this from a range of financial institutions. What is the struggle right now?
That's an interesting question. I don't understand it quite, because you have a time where a lot of companies are laying people off. So there is a frustration of going back into the office and not having the flexibility you might have had before. However, you also have a lot of anxiety because it's not like business was as booming as it was a couple of years ago even. Activity is also coming back. If you look at the banks, for example, you have a lot of private equity firms ready to put money to work. They expect valuations to come down more to do so. I think back to a conversation I had with the Vista president, for example. He wants to get 3 more takeovers done before the end of the year. They've been buying public companies. And so you need money to get that done, and you need people to be at work to get that done.
How much is the change in rhetoric really an endorsement of what Citigroup's Jane Fraser was talking about, which is, and she wasn't that subtle about it, it really didn't work, and that a lot of people were not that productive when they were working from home, and so they would bring them in for retraining or whatever euphemism that she put out there. Is this basically the feel right now in the C-suite across Wall Street?
Yes. I mean, I think back to the pandemic and a conversation I had with the former CEO of Carlyle, for example, who was putting a lot of work into how to make people feel together on Zoom. The reality is it's really hard to have a meeting that way sometimes. I don't want to say that there hasn't been some shifts, because even over at BlackRock, you still can work from home 2 weeks of a year. That's kind of standard now at a lot of companies. Citigroup allows that at the end of the last year. They just let people work from home at the end.
This just gets solved instantly when there's a 2-tier pay structure between people that come into the office and people that don't. Is that where we're heading?
You want to be in front of your bosses. I mean, isn't it kind of just as simple as that? Again,
I'm just like over 1 year, 2 year. John, help me here. Over 1 year, 2 year, 5 year cycle. I don't care if
We've
it's
talked
London,
about
Hong
this.
Kong, whatever.
You and I totally agree
I
on this point, Tom.
I just think we're heading towards a 2-part. If you want to work from home, great. Work from home, you're going to make less money? Is that like in the zeitgeist?
Yeah. I mean, the people that are coming in, again, are in front of their bosses. They're getting things done with velocity. They're usually in early. They're late. And so there's another kind of dynamic to this as well, which is travel is coming back. And so people are in the... I was with somebody just yesterday that had been in 5 countries in 3 weeks, right? And so people are very active right now. And again, I think that is kind of a sign of things coming back, and the banks and the asset managers trying to push things back when activity is so muted.
That's the romance of it. Some stud on an airplane flying to 5 countries. Forget about it. What's the staff doing? That's what I think Lawrence Fink wants to know.
They're flying coach up and down to Florida.
Yeah, and I'm fascinated if the staff at BlackRock or Goldman or Bloomberg or whatever are going to come back.
I think another question is where they're coming back to. I think there's been this discussion for a very long time about this big move to Miami. I think a lot of people are also starting to move back. Again, a lot of these companies, the headquarters, are still in Manhattan. I think that'll be an interesting tension in the next couple months.
I think language is important, and I think we've all been caught out by saying the same thing. We keep saying get back to work, when what we mean to say is get back to the office, because there's a lot of people listening to this saying that I work fine at home. I'm doing pretty well. I can get things done. I don't need to come in and be disrupted by a bunch of people, sit at a tiny desk. Struggle to find a desk at some financial institutions. That's the story the executives don't talk about much at all.
That's a very frustrating situation, this
Let's get back.
Hoteling of the desks.
Yeah, right. Let's get back to work. Have they got the floor space at some of these banks to do that?
Some of them, yeah, but there is a lot of hoteling going around if you're not kind of on the top levels, and it is very frustrating. People are asking for it. Going to different desks.
You're sharing desks.
Sharing desks?
Yeah, that's a thing now.
Really?
And it's very, people ask.
I had a ginormous desk, and I came in one day, and it had shrunken down over the weekend by me. I'm knocking elbows with Matt MacArthur, who, we're not on speaking terms.
You've got a tiny desk.
People bought homes outside of the city and in different states. So I think that's the difficulty in bringing some people back who have potentially moved.
It's hard to get our hands around this, partly because there's a real difference in the boss's perception of how productive people are when they work from home and people's perception of how productive they work at home. There's a massive divide. In general, executives don't trust that they do anything, and people say that they just aren't seen and heard. There was a Microsoft study that suggested this late last night, but how much is this becoming, late last year I should say, how much is this really becoming much more of an issue because banks are looking to cut headcount, that suddenly it isn't necessarily as much of an uneven demand and supply issue in the labor market?
I think people need to pay very close attention to that, because I think they saw massive headcount reductions last year from the likes of Goldman Sachs, or even on the margins at some other banks, but you're seeing second rounds of job cuts now occurring. And that continues if the economy remains very weak, if the environment for deals remains very weak. And remember, fundraising is really tough for a lot of firms right now, too. I think it is really tough out there still, and until that turns around, there's no evidence that things would get better. Young people too, Lisa, I've got to say, they have different jobs now than they used to have. So if you were an M&A banker at a bank, now you might be being moved into restructuring a capital structure for a firm. You might not have learned that in your internship at that same bank. And you need to be there in order to learn those things.
In front of the boss.
In front of the boss.
Yes, self-selection. Self-selection is going to be the story. Look, regardless of what I think about whether you should be able to work at home or work from the office, if you want to progress, then I think without a doubt, to get the edge, be in the office in front of management. That makes sense, doesn't it?
How about what Elon Musk had to say yesterday? He was talking in an
he's
interview.
He's got stronger language about these things.
People building the cars, servicing the cars, building houses, fixing houses, making the food, making all the things that people consume. It's messed up to assume that, yes, they have to go to work, but you don't. It's not just a productivity thing. I think it's morally wrong. This is what he said in an interview, Elon Musk of Tesla and SpaceX. So there was that shift as well.
Well, assuming that all desk jobs are all high-paying jobs, and they're not. Some of them are highly depressing call center jobs where you just don't want to get in the car and go to these places and work there, and you find it much more comfortable doing it from home. We're having a conversation about high-paying banking jobs where graduates
about the staff.
are earning $150,000 a year, which is nuts.
Well, how about childcare too?
Sure.
Childcare, and something a lot of the banks have been doing that is new is, they've been still doing things like every so often buying things from local restaurants to make sure that the local economy is still supporting the needs of the staff that they're trying to bring back to the city.
My favorite story of all of this in the pandemic, there were two. In fact, I think they both involved Goldman. I like the reports that David Solomon got fed up of bumping into people in the Hamptons. And I was just like, come on, dude, set the example here. One. Two, I also loved the story of that first-year grad that had the PowerPoint presentation. I mean, talk about turning soft at some of these institutions in the pandemic. You had this PowerPoint presentation about what needed to change, and they were taking it on board, and they made some changes.
Those days are gone.
Here we are 2 years later. I dare you to make that PowerPoint presentation at Goldman now and present that. Let's see how that works out. Janani, thank you. Love it, as always. In fact, send it to me before you send it to them. I enjoy reading it.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compact merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration. With regards to the hybrid
work model. Do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The economy has been proven to be quite resilient.
We still have central banks across the globe that are trying to fight inflation.
It's not going to make a big difference to the economy if the Fed hikes in June or waits in June, maybe hikes later on.
We're seeing these lags start to play out. You have seen inflation decelerate. It's probably going to continue to decelerate.
I still think that a recession is unfortunately somewhat unavoidable.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene work from office. Andrew Hollenhorst work from home. Marvin Lowe work from home, and on and on. That was a great debate there with Sonali Basak. I hope you saw that in the last hour, folks. It's here. The pandemic's over.
The key word is work. They're working, TK. I think they'd say the same thing, wouldn't they? They're working.
Okay, can I just take some issue with that open? Just because they were working from home at 6 a.m. to join us, they could have been going into the office after that.
Yes,
I'm just saying.
Completely
Thank you
fair.
for joining our show.
You're fired up this morning.
Well, she is.
Well,
but,
we gotta
the pandemic's over. We got a lot of people coming in. We got a wonderful guest here to start strong in this hour. And John, I look at it, and we're still talking earnings season. Its impact on the Fed. Is there an effect in economics of what we're seeing from retail, which is 70% of the American pie?
What was interesting from the Fed speak in the last 24 hours is how few members wanted to commit to a pause. As early as June. Thought it was interesting. The only one that's really come out and said that almost explicitly was Goolsbee of Chicago, who basically said it was a close call for him in May. But for others, Mester, you might expect that hawkish tone from the likes of Mester. Williams was talking about the wait-and-see approach, like Governor Jefferson. We've done a lot. Let's see what happens. Let's wait and see. Then Thomas Barkin turned around and said, yeah, we can wait and see, but also inflation's too high. And if we need to do more, we'll do more. Yeah, so I think the door's still open there.
My theme, or Lisa, help me out here, is January was buoyant across everything we talk about. February less buoyant. There's a trend here. March, April, we're into May, and I really don't have a handle in any way, shape, or form about what Q2 GDP looks like.
Paddling duck. I just keep thinking of the paddling duck.
Amy Wu Silverman.
That Amy Wu Silverman's talking about, and it's not just in options and various derivative trades. It's also with respect to sectors in the economy. You have some that are accelerating, some that are decelerating, and then it shifts, and all of a sudden, it's hard to get a handle on whether inflation can actually go down in a material way if you're getting these cycles that are repeating independent of one another.
I'm going to do an audible here, John. We got the President of the United States overnight saying the Pacific Rim sojourn north to south, Japan to Papua New Guinea to Australia, that's off the market. It's about the debt ceiling at the same moment where renminbi goes back to 7 yuan per dollar. That's that China slowdown tension. And I think it's interesting to conflate those two stories together on a Pacific we're ignoring.
Kit Juicer SocGen talked about this morning in his morning note that we're starting to see that currency pair shift. And if that's going to be the direction of travel, does that breathe some life back into the US dollar? Again, we've seen just a little bit of that over the last week against the euro. I think it's worth keeping an eye on because we came into this week and it was all bulled up on euro, bulled up on the rest of the world. China driving that in the reopening. And there's just some data over the last week that's pushing back against that theme. Just a touch.
On the data, I'm going to go right there, John. Dollar renminbi, 6.99 rounded up, 7 yuan per dollar to get us started here on the data chart.
I'll keep it basic on the S&P 500, positive by 0.4%. Equity futures slightly positive here. Yields a touch lower by a basis point, 352 on a 10-year. There's that euro weakness, dollar strength for you on the screen. The euro against the dollar. Euro dollar 108.27, Tom. We're negative there on that currency pair by 0.32%. 5%.
For Global Wall Street, this is our conversation of the day. Alicia Levine is head of investment strategy at BNY Mellon and joins us with prodigious mathematic and quantitative finance ability around the stock market blather of the moment. Link your two worlds together, Alicia, here, the dynamics you see in quantitative finance, the four cross moments, over to what TJX is doing. Put those two worlds together in this chaos.
So the chaos is that not just monetary policy having long and variable lags, but fiscal as well. And I think the message from earnings season is that there's still inflation in the system. Because ultimately, if you think about the big box stores, what's happening, the goods revenue is lower, reflecting lower pricing possibilities, and the goods inflation just rolling over altogether, but still inflation in the system on services. And that's really what you're seeing in the earnings here. So not exactly surprising. I mean, we'll see. We have other big box this week, and if there's food involved, food has double-digit inflation, and that'll make a difference on the top line, right? Because in the end, earnings are nominal. We're in watch and wait. The market is waiting. The bond market is saying recession. The equity market, even though it has been solid this year, driven 90% by 7 stocks, which are defensive in nature. And the cyclicals are weak, and under the surface, it's weak. So even though on the index level, it looks like the market's saying soft landing, actually the action's been very defensive.
Can you make the argument then that the equity market is pricing going to slow down in the U.S. economy?
What's working in the market are the sectors that should do well in a slowdown. So it looks like the equity market is starting to price it in as well. But clearly the message has been this way from the bond market. And the data in the real economy, by the way, has been much better than expected. As we've all been talking about, this slow walk to the recession is now a slow crawl. However, I find it very hard to believe that the Fed hikes 500 basis points in 13, 14 months, and we don't get an impact on the credit side and a contraction in credit down the road.
Before we get to down the road, just the idea here that the economic data has been coming out better than expected and that people are so defensively positioned. To Amy Wu Silverman's point, could you see a scenario where people actually have a rosier outlook? They revise upwards some of their ideas for GDP, for growth in general, and that leads to a sell-off on the index because of a downgrade in some of the big tech valuations?
Absolutely. When you get a divergence like this, where you have large cap tech or those top 7 names outperforming and the other 493 underperforming in such a huge way, I mean, it's typically that gap closes. So either the large cap move lower or all those other stocks move higher. I suspect that the larger cap stocks move lower here because they're very extended. The multiples are no longer that cheap, by the way. There was some of those stocks were cheap coming into the year, no longer. The stocks are up 30, 35%, 70%, 100% in some of them. So that's no longer an easy place to put capital because they sold off so much.
How significantly could you see a downdraft in big tech?
It's really going to be centered on what's happening in the real economy. So to the extent that cyclicals look more attractive, very interesting on the dollar, by the way, that discussion's very interesting, but the dollar weakness has helped a lot of these companies. And to the extent that the dollar stabilizes or re-strengthens, that's where you're going to see the hit. I can't put a number on it, but I'm telling you, I think the gap is going to close here. Going back to the dollar for a second, you know, the move in the dollar lower happens mostly in the fourth quarter of last year. The dollar is only down 1% this year, year to date. And so the question is, that's what's really stabilized global equities, the weakness in the dollar. What happens if you know, China's a little bit weaker, the U.S. is a little bit stronger? The Fed conversation is fascinating because what it means is they have to act like June is live. But what if June is live?
Yeah.
Like, you know, I mean, the assumption is June is not live. Fed speak is June is live. What if June is live? And that would be an interesting thing.
And I would say OBE, they're overcome by events always, and we don't know what those events are right now. I like the Pacific Rim analog there. I want to go to the mathiness of this. Peter Bernstein, Against the Gods. You've got risk, you've got uncertainty, you've got Douglas North's ambiguity. You're expert at this. Is this a jump condition we're in of the interest rate move where we're uncertain, we don't know what's going on, or is it just a discontinuous function where we're in control of ourselves right now?
don't think anybody's in control. I mean, everybody's unhappy. The Bears are unhappy. The Bulls are unhappy. Everybody's sort of universally unhappy with this market here because it doesn't make sense. I mean, there are people who've worked in this market 50, 60 years who say it's the most confounding market.
This is brilliant. Can you invest in a risk way, or are we investing amid uncertainty?
We're investing amid uncertainty, with the market stronger than anyone thought coming into the year. Our portfolios are neutral on equities, neutral on fixed income, which, by the way, is which is higher than where we were last year, where we were underweight. And we're coming into this neutral because we want to get more risk accepting. Should we get that sell-off coming from the real economy? But we're not there yet. And it just feels with the S&P hanging out between 4,100 and 4,200, it's not great for adding the risk today. But that doesn't mean you don't end the year higher. We think we end the year more or less here, even if there's a difficult moment in the months to come.
Do you remember the consensus view for the year ahead? First half dip, second half rip. Do you remember that?
Yeah.
That was on the S&P 500. And I think we said, wait until March. Put the outlook out in March. And then if you had put the outlook out in March, you would have missed the bank failures. And then if you knew that the banks were going to fail, you probably would have missed the fact the equity market was still going to rally.
To be fair,
it's difficult to call this market.
Some people could say there was a dip in everything but 7 stocks. And maybe those 7 stocks will rip, but the dip will actually happen in the second half on the index level, but it'll rip underneath. I mean, this is the reason why it's so confusing, trying to make sense of something that really can't be generalized.
Reminiscence of a stock operator. I think Alicia Levine said we end the year here, so that means we can work from home and take the rest of the year off.
We can all work from home. That's
Sell
right,
in
Tom.
May and go away.
That is the appropriate conclusion to that conversation.
You can use that phrase if you
Alicia, thank you. Wonderful as always.
Thank you.
Appreciate it. It's good to see you. Good to see more and more people in person this morning.
It's a huge deal.
Alicia Levine of BNY Mellon Wealth Management.
Yeah, you know, it's just
told to get into the office and go to the studio.
Are you like working from office, work from home, work from airplane? What are you doing?
I work from airplane and work from office.
Okay, thank you.
Can I just say what she said there about what if the Fed has to say that they're going to hike in June, but they actually do, and they hike rates, and this causes a massive increase in the dollar valuation versus everything else, especially in light of everything else, and that just upends all these trades. Fascinating.
I can't
fascinating
emphasize enough how that's one of the things that people aren't looking for. It's one of, I look at Ed Hyman's disinflation call, and I look for resilient or stronger dollar. Nobody's looking for it.
Andrew Hollenhorst, Citi, just published. Activity data for April, including solid retail sales and industrial production, suggests growth may accelerate in Q2 rather than slow as the Fed intends.
He just stole that from Alicia Levine.
Also inconsistent with a slowdown, housing activity is bouncing back from low levels. This is Alicia's point going into June.
Yeah.
They're trying to make out it's live, but maybe it's live.
Amy Wu Silverman saying, look at the right tail of the tail optimism, because no one's looking at it right now.
Up next, Libby Cantrell of PIMCO on a debt ceiling from New York. For our audience worldwide, with equities positive 0.3% on the S&P 500, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden and House Speaker Kevin McCarthy are expressing cautious optimism that they can reach a deal on raising the debt limit. That would avert a potentially catastrophic default. Negotiators want to come up with a framework agreement, that is, by the time the president returns from a shortened trip to Asia. In Japan, the economy expanded at a faster rate than expected in the first quarter. Gross domestic product rose at an annualized pace of 1.6%. A further easing of pandemic regulations led to an increase in consumption. Now, that will likely keep speculation simmering over a possible early election and potential central bank policy change. Target says that softening sales trends are likely to hurt its short-term results. The discount retailer predicts that earnings in the current quarter will fall short of estimates. Target is standing by its annual profit forecast. It sees consumers buying fewer discretionary goods, things like home furnishings and electronics. UBS sees an estimated $34.8 billion gain as a result of its emergency takeover of Credit Suisse. Still, the Swiss bank warns that it faces billions in potential legal and regulatory costs from the rescue of its former rival. UBS stands to benefit from the combined firm's negative goodwill. And Broadcom is trying to get European regulators to approve its $61 billion takeover of cloud computing company VMware. Broadcom has offered antitrust commitments in an effort to alleviate concerns about the deal. Meanwhile, EU has extended its deadline to rule on the transaction to July 17th. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
The nature of the presidency is addressing many of the critical matters all at once, so I'm confident we're going to continue to make progress toward avoiding default.
The president agreed to appoint a couple people from his administration to sit down and negotiate directly with my team, so I found that to be productive personally. But we've got a lot of work to do in a short amount of time. It is possible to get a deal by the end of the week. It's not that difficult to get to an agreement.
It's not that hard. It's possible. Some soothing words, constructive language used by the president and House Speaker Kevin McCarthy. The second round of high-profile, high-level debt ceiling talks between the two leaders. Those talks will be ongoing, Tom, at a staff level through the rest of this week. And once the president returns from the G7, maybe there's a framework for agreement. That's the optimistic way of thinking about it.
For those that are not up to speed on this, like me, I'm not up to speed on this. It's been in the last 24 hours a shift. No question about it. I mean, it's a more conducive tone.
A shift in language. I have no idea what kind of deal Speaker McCarthy needs to get through the House, and we can talk about that, Tom, throughout this morning and beyond. Getting to an agreement between the president and others is another thing.
And as a sidebar, we haven't even talked about this, but is the X-date nudging closer because of the tax receipt dynamic?
This is how I'd frame it, and
early June?
I'd be interested to see how our next guest frames it too.
X-date.
The Treasury Secretary said early June. You'd imagine she was being conservative and maybe having a couple of weeks of a cushion baked into that projection, Tom. That would be the sensible thing. But even with that cushion, I think a lot of people are putting things forward a bit, TK, based on those tax receipts. Yeah, I think that's probably the right way of looking at it.
First time I saw X-date, I thought of Dana Scully and Fox Mulder. I thought, maybe it had something to do with,
the X-Files.
X-Files.
Yeah, good times.
Ago, but
different decade.
There is well. Futures up 14. I'm looking, John, the market's not giving us anything today.
Target call getting underway, Tom.
407.
Stock is up by 0.7%, slightly positive on target this morning. Futures positive. No real drama out there, TK, just status quo. And to Lisa's point, we were talking about this with Amy Silverman, the duck market. I prefer a swan, slightly more elegant.
No, I like ducks.
On top of the water. not much happening and aggressively paddling beneath the surface.
So
That's your
elegant,
market
though.
call.
You
That's
think
your
this is elegant?
Yeah,
No,
that's
it's
your
a duck.
market call for this morning. Ducks on a pond. Right now, to drive us forward in Washington, if I was to say all this, it would be, well, maybe, Tom, that's off the mark. But when Libby Cantrell writes about pearl clutching in Washington, you pay attention. It's Mikamoto double A's and Tiffany strands of pearls down there. I love how you do that. Pearl clutching in Washington. Is Margaret Chase Smith, the ghost of Margaret Chase Smith, down there clutching the pearls right now?
Yeah, yeah. I mean, I think there's been quite a lot of hysteria, pearl clutching, if you will, regarding the debt ceiling. But our view, and I think to your earlier conversation, certainly the mood music is positive. We would argue the mood music has been actually quite positive for quite a while. I think the contours of a deal are absolutely there. The details just need to be filled in. The fact that they have Shalanda Young, Steve Ricchetti, these people are serious sort of adults in the room. They are going to be the president's proxy while he's in Japan. And I wouldn't be surprised if we didn't see a deal by this weekend. I mean, I think that I think a deal is imminent. I actually don't think it's going to necessarily require the equity market or equity vol like we've seen in previous debt ceilings.
That seems to be the conclusion of so many people, though, on Wall Street, that you need to get close to a crisis before you get a solution. Why are you taking a slightly different view of things?
Well, again, and John, I've just been looking at the political incentives here for several months, and nobody has any sort of political incentive to even get that close to default. I mean, if you look at sort of Speaker McCarthy's hand, I mean, he doesn't necessarily have a very strong hand going into these negotiations. He only has a 4-seat majority, meaning he can only actually just lose 5 members in order to sort of stay along with this deal. And I think very importantly here, President Biden has been now open to negotiation. So I think there's sort of if you just sort of look at the kind of political landscape here, the bottom line is that a deal will get done. And I think, again, sort of in advance of the X date. And to Tom's earlier point, the X date is real here. And I think this is where Secretary Yellen has now kind of corroborated her earlier estimate of June 1st. I mean, tax receipts are quite weak, not only because of personal income taxes, but because of this sort of disaster zone dynamic, particularly in California, where a lot of folks are actually not having to file their taxes. And so that is going to be delayed receipts to the government. So, we think that the X date has to be taken seriously, and we think members of Congress are also taking it seriously. So this is all a long way of saying that despite the pearl clutching, as one staffer said, passing the debt ceiling is like passing a kidney stone. We all know it will pass. It's just a question of how difficult it will be. Sorry for the graphic analogy.
Sounds pretty brutal.
But that I think has been our operating assumption and is the market's operating assumption right now as well.
The paddling duck is going to pass a kidney stone this morning. It's been quite something. One of the reasons why I love speaking with you, Libby, is because you have incredible experience working on Capitol Hill. You understand the political wranglings that go into getting this done. What do you think the contours of this deal will look like? What changes will really take place?
Well, look, I think very importantly is sort of the semantics here. So President Biden will characterize this as a budget deal associated with fiscal 24 spending, where Speaker McCarthy will characterize this as a debt ceiling deal. I would say that's a distinction without a difference and from a market's perspective. But what we're expecting is that there will be some rescission of the unspent COVID money. That's not very much. It's about $40-50 billion, but it still kind of helps from a deficit perspective. We also expect some sort of down payment on energy permitting reform. That's something actually important both for Republicans and for Democrats, so that arguably could be a win for both. And then importantly, some sort of spending caps. Now, this is going to be where the devil's in the details, because of course, if you remember 2011, there was a Budget Control Act as it related to the debt ceiling, and the market sold off because they were expecting big spending cuts and sort of fears of recession and what have you. We do not expect significant spending cuts to be associated with this deal, but we could see a slower growth of spending, and that could also help these deficit forecasts.
There's kind of an irony here. If the market is expecting volatility and expecting to have to respond eventually and not expecting a deal, do you expect market volatility in response to a deal that you see as soon as this weekend?
Well, look, I think that we have to talk about which market we're talking about, because, of course, the fixed income market, where PIMCO manages most of its assets, has reacted, right? There has been a dislocation in the Treasury bill market. There's been a big risk aversion around the bills that have expired closer to the X date. We saw that in the auction most recently in terms of the yields. And so we already are seeing some dislocation in the fixed income market. But to the market that most people refer to, the equity market, we haven't seen that. And actually, we could see, I think, a little bit of a relief rally as well, even from here, because some of this sort of anxiety and uncertainty, I think, has been priced in to a small extent. And I think if a deal is sooner than folks expect, is pulled forward, I actually think you could see a bit of a relief.
Dovetail your work with the PIMCO call in Newport, the idea that we're at a 5% general statement on short-term paper. Do you guys believe we're coming in, yields will come in and frankly benefit Washington as well, where 5% becomes, say, 3.8% cash yield?
Yeah, so I think that our view in general in terms of the Fed and the economy is that the threshold for the Fed to cut is going to be high. We think that the Fed is going to have to see a sustained economic slowdown before they start cutting. So I think we disagree a bit with where the market pricing is, and even what CEO Jamie Dimon said today. With that said, though, we are expecting, and I think you had Tiffany on your show yesterday, we are expecting a mild sort of slowdown at the end of this year, at which point we do think the Fed will likely respond. But again, the threshold for them to get off of around 5-ish or what have you is going to be quite high. So they're going to have to see a sustained economic slowdown. A couple of bad jobs numbers is probably not going to do it.
When was the last time we got to do this? Sit around a table together,
nice.
Libby. How many years has this been?
In the last 2 weeks, and this
it's just started to pick back up. I've said that a few times this morning. It's happening.
Let's go.
People are getting back to the office. Are people getting back to the office there?
I mean, we've been
never left.
We've been back for a very long time. Yes,
never left.
We never left. Thank you, John. That is actually correct.
Libby, Libby Cantrell of PIMCO. It's EK coming up in the next hour on Bloomberg TV. I'll catch up with Matt Miskin of John Hancock Investment Management, Sarah Malik of Nuveen. We'll talk about some of the retailers, what's happened with Target, Home Depot, looking ahead to Walmart tomorrow. And then Peter Giacchini of Exonic Capital joining us about 9:30 Eastern time. So just around the opening bell, Tom, a little bit later this morning.
I think it's a week to reframe. I mean, there's not that much economic data, and I know we're collared and range-bound as all, but I'm sorry, there's a lot going on. And I would allude back to, can you get Jay Pulaski on here in the coming days? Because I really want to know what Jay Pulaski thinks about the Pacific Rim. It's a mystery to me.
And just maybe the little cracks in the data in Europe, in China, where he is on that dollar call.
Well, you could get Al-Arian on as
right
well.
Now.
You talked to
We only spoke to Mohammed yesterday.
Oh,
he can come back if he wants to. Catch up with Mohammed again.
Come in early. We can talk Jets football.
I'm sure he'd love to do that. Aaron Rodgers.
Yeah.
And Broncos.
And Broncos.
If I may just answer myself.
Squeeze in some Broncos.
Turn it off.
Livy, thank you. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg Surveillance, Lisa Bramowitz and Tom Keene. John Farrow in preparation for an important 9 o'clock hour. Futures up 13. The VIX 17.67. Lisa, we haven't moved in like weeks.
It's peddling duck.
That's peddling duck, as Amy Silverman would say. There we are.
Yeah, but I feel like things have changed. People are coming around to this feeling that perhaps the banking crisis is almost over, or getting there, and that suddenly the upside surprise in economic data is really what people have to be focused on.
We need to look at the economic data right now. Any upside surprises? Michael McKee reporting from a Fed meeting where everyone spoke. Michael McKee, good morning.
Good morning, Tom, and we do have some good news, an upside surprise, you could say, in terms of housing starts and building permits. Housing starts up 2.2% after falling 0.8% in March, and the building permits number is down 1.5%, but that's better than the negative 8.8% that we had seen. One of the things that was being discussed down in the Atlanta Fed conference was whether the housing industry was really taking it on the chin because because interest rates have gone up and mortgage rates have gone up so far. But the general consensus of Fed officials is that the builders in their district are telling them they don't have a problem because there's so much demand for housing. They can still keep putting holes in the ground.
Michael, you're traveling today. What was the lesson you learned from the 322 Fed speakers at Amelia Island?
I think, Tom, the important thing for people on Wall Street to realize is that there isn't a consensus yet for what they're going to do in June. There was a feeling that a pause was baked in, but even those who are in favor or leaning towards a pause, like Austin Goolsbee, are very cautious because the inflation numbers haven't moved as much as they want. And of course, they've been expecting unemployment to go up, and they haven't done that. So the feeling is they want to wait till the last minute to decide what they're going to do in June. I wouldn't bake in a pause yet.
Michael McKee, thank you so much. Safe travels and just terrific coverage, and particularly Goolsbee and Barkin down in Atlanta, the Amelia Island conference. Always important, somewhat like Jackson Hole, which is maybe a little more visible, but these are important conferences. Lisa, all the different regional banks have these conferences, and frankly, from ultra accommodative where it was easy to accommodative where it was easy to somewhat restrictive, debate there, where it was less easy, and now it's just excruciating to go comment to comment from the Fed officials.
There's nothing easy about this moment. I mean, even within the real estate market, we just got to read on how basically people are starting to build houses, but they're not getting as many permits. People want to keep buying at a time when Fed officials are warning about commercial real estate and the potential risk to some of these regional banks. Putting this together, incredibly difficult to get some sort of overarching narrative.
It's going to be interesting seeing. The narrative always happens at resorts like Amelia Island. He's writing about the last resort at the resorts. Michael Gapin joins us now, head of economics at Bank of America. Securities, I like the idea of the last resort. They really don't want to cut rates. What does history tell us about when they do cut rates?
History would tell you that the housing sector would bounce back quickly. All the sectors that have been in trouble recently would bounce back strongly. But history tells you the Fed's cutting rates for a reason. They're either achieving their goals on the inflation side in this case, or there's been a stronger downturn in the economy and policy is shifting towards helping activity recover. So typically when the Fed cuts, there's a reason for them to be cutting.
They keep pushing back on market expectations for cuts. And Andrew Hollenhorst of Citigroup has kind of been out alone saying that this Fed is completely underestimating how much the inflation is out there and they need to keep hiking even potentially in June. Do you see that as an increasing likelihood based on the data that we've been getting?
Yes, we've been saying that a hike in June can't be fully ruled out. There's obviously a lot of hurdles we need to get over to make that decision, but I would still put a hike in June or July at kind of the 30 to 40% range. That the data on net is still pretty strong. The Fed has an upward bias, and if it probably needs to see 2 to 3 months worth of evidence to make that decision. June is a pause at the moment, but certainly I think you could get to a hike in June. I think you can certainly get to one in July if you felt you needed to.
As Tom described this market and this economy as excruciating, he is not wrong. I'll give you an example. As we get these retail earnings, home goods, clearly seeing a downdraft, people not buying home goods as much, whether it's Home Depot or TJ Maxx. But then if you look at makeup, if you look at food, if you look at services, that's all continuing to blossom, and even these companies pass along price increases. Can a rolling recession in different industries like this prolong the type of inflation that we have seen far beyond what people have currently expected?
Yes, I think so. And the Fed is, we all know the Fed's not out there saying, oh, we need to engineer a recession to break the back of inflation, right? They're saying we need to lean against the wind. So it's not all up to us. And so we're just trying to put policy in a, quote, modestly restrictive stance. That means you can get, I think, rolling slowdowns across certain parts of the economy where any downturn would look more, say, U-shaped than it would V-shaped. And so you get a wide dispersion in the data where some spending on lodging, for example, looks like it's peaked. Airlines are a bit mixed, but spending in things like cruise ships or travel abroad is still strong. So the reopening phases, the normalization of spending makes a lot of this data look, really at odds at certain points in time. So it's possible you could see that continue for some time.
You studied in school, Michael, that statistics for the modern age started about 1947. And one of those series that we have on the Bloomberg, and Chairman Greenspan loved it, was the all-in augmented unemployment rate, which is 6.3% right now. It's a gloomier statistic, and it speaks a lot to the tension of unemployment. We are 2.2 standard deviations to fully employed on that statistic going back 60, 70 years. It's a fully employed America,
correct,
right?
Yes.
I mean, statistically we're fully
speaking,
employed.
Yes.
Why are we talking about cutting interest rates? I'm baffled by this.
We're not. I don't think the Fed is either. So I think you're in a situation where some sort of they land this right and you get a higher for longer outlook. But I think in general the need or the desire or the want for cuts sooner than later is a little misplaced. There are certainly paths to get those cuts. I'm just not sure they're as close to baseline as people are thinking.
I mean, Lisa, what's so important here about the oddity of a pandemic and, all the other dynamics we talk about all day is people like Michael Gapin with huge credibility and earned credibility are looking at, quote, other factors involved. And we want Jerome Powell to fix our other factors involved. And he doesn't have the tools to do that. It's completely irresponsible.
So there's that issue. And then there's also the other factors involved when it comes to the actual pricing in markets for rate cuts, which include most people saying probably they're not going to cut rates this year. But if there is some sort of crisis, you could get some pretty dramatic cuts. Is the economy that you're watching, with the labor market as tight as it is, with this feeling that consumers are continuing to be able to spend, less perhaps vulnerable to the shocks that people have been worried about all year long and in their frustrated, anxious states?
Well, the economy certainly has shown great resilience, and you're right. There's spillovers from debt limits. There's concerns about regional bank funding models and so forth. And yeah, those could propagate in ways that are very unhealthy for the economy. But that's unlikely. The data shows that the stress in the regional banks appears manageable. To your point, though, I'd just like to affirm or amplify what you said. The Fed isn't here to fix everybody's problems, and Fed hiking cycles cause pain in certain parts of the economy. That's true. That's been true in every tightening cycle, and you need that in order to bring inflation down. So in some ways, we're a little bit bipolar. We know we want the Fed to raise rates to moderate activity to bring inflation down. We all know that's good for the economy in the long run. But when the pain of that shows up, we all want the Fed to run to the rescue and fix our own individual market. That's not what the Fed's there for.
So I want to bring to you something that we heard yesterday from Austin Goolsbee, who was talking about immaculate disinflation.
Mm-hmm.
He said that people who try to talk down that concept of immaculate disinflation are perhaps fooling themselves because there was an immaculate inflation. And so there could be immaculate disinflation. That's actually part of what we're seeing. What would you say to that?
I'd say that's part of the story. So if you go back and you think that some of this was excess demand and some of it was a supply shock, the immaculate disinflation can come from cleaning up the adverse supply shocks and the resumption of normal supply. That should help bring inflation down on its own. But to Tom's point, the labor market is as tight as it's been in my lifetime. If the labor market's cooled down, it's cooled down from exceptionally hot to as tight as it was in the past prior cycle highs. So there, I think you're not going to. It's unlikely to get immaculate disinflation when you're trying to reverse that. So it's a mixed story.
Michael, I want you to look at the global purview of Bank of America, the great work that you and Ethan Harris are doing. And that is, I see unsettlement. I see the Turkish election with Turkish lira coming out, obviously weaker lira with the uncertainty out 2 weeks. I see Argentina, where the blue dollar Argentina peso is something you and I have never witnessed. You've done this at the IMF as well. This morning we have Ecuador dissolving their parliament. There just seemed to be that early 1998 tension out there, little butterflies flapping, if you will, to use a worn-out cliche. Do you sense that at Bank of America?
Not yet. I would add maybe the election outcomes in Thailand, for example. But it's a good point that there's a series of elections where there's been some surprises and still some momentum in populist candidates. The message there is still one of potential change and say, an unsettled political environment. Obviously, we have some of that still here at home. So I wouldn't say we're at that moment yet, but you're right. There are undertones where some of the patterns today repeat what we had seen in the past.
30 seconds. Is Jerome Powell central banker to the world and to all these butterflies out there with tensions and realities?
Whether he likes it or not,
Whether he likes it or
yes.
not, absolutely.
Yes.
I think it's way underplayed, Lisa. I think, the actions that we're looking at in the United States, including tangentially this debt ballet we're going through.
Talk about, Alicia Levine was talking about that if the Fed does hike rates in June, what happens to the dollar? And then how does that sort of disrupt the rest of the world and their economic policies?
Yeah. It's interesting. I mean, Dr. Gapin's entourage folks, they said he can't talk the debt ceiling. I mean, when he came in, he just said, he's not going there.
Well, apparently it's like passing a kidney stone.
A paddling duck. Yeah, a paddling duck.
That's a great comment. I'm like that, Libby. That was perfect.
Passing a kidney stone.
Well, we've had a lot to do. We've done Law and Order. We've done sports shows, and now we're doing Dr. Kildare. I guess so. Michael Gapin, thank you so much at Bank of America Securities. It is most interesting out there. I'm not going to quote the Ecuador currency, which I think is dollarized. I can't remember right now. Argentinian peso yet to trade today, 231. That is a point of international tension. SPX futures up 13. VIX comes in 17.67. This is Bloomberg Surveillance. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. A smaller group of negotiators will head back to the table to hammer out details on the debt limit after President Biden and congressional leaders failed to come up with an agreement to avoid a default. President Biden leaves today for a Group of 7 meeting in Japan and says he hopes to resume talks when he's back in the country next week. This morning, House Speaker Kevin McCarthy told CNBC he's confident there will be no default on the debt. Former Vice President Mike Pence is calling for an end to the Fed's dual mandate. He says the central bank should focus only on fighting inflation and leave jobs creation to Congress and the president. Pence told Bloomberg the Fed should return to its historic mission of ensuring sound monetary policy. He's considering challenging Donald Trump for the Republican nomination next year. Bank of England Governor Andrew Bailey says he is unwavering in his commitment to the UK's 2% inflation target. At the same time, he's warning that higher food prices and a tight labor market could cause the cost of living crunch to persist. Bailey spoke at the global annual conference of the British Chambers of Commerce. India is launching a $2 billion plan to attract makers of laptops, tablets, and other hardware. Prime Minister Narendra Modi is capitalizing on the early success of Apple's iPhone assembly operations in India. Tech companies have been looking to expand supply chains beyond China. And in pro basketball, the San Antonio Spurs were the winner of the NBA's most anticipated lottery drawing in the last 2 decades. The Spurs have won the right to draft French teenage star Victor Wembanyama. Now, he is 7'4" and is the most highly acclaimed young prospect since LeBron James. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I promise to cooperate with the regulators as they do.
Are you planning to return a single nickel to what you cost the fund?
Senator, I know there's going to be a process review of compensation.
I'll take that as a no. So you're planning to return how much?
The answer is
none. That's it?
I'm not planning to do so, no.
Oh, that is Scott Shea of Signature Bank at the Jenny Montgomery Scott Conference with Senator Warren as the guest questioner yesterday. That was really something. I mean, you expect to see it. But again, as I said before, this is one area where she has massive credibility.
And she
in bankruptcy and regulation.
She staged a drama too that will I'm sure play
Yeah.
on repeat for a lot of people.
Director of Drama at Jenny Montgomery Scott, Christopher Marinac, joins us right now. Chris, it's an honor to have you on, and thank you so much for your coverage here through this crisis. But the bottom line is, we're all watching this as theater. You actually know these people. Let's talk about Mr. Shea and Signature Bank, which your shop covered as well. First of all, were you surprised they went down the tubes?
I was surprised because I think that they had enough liquidity to stave off the first couple of days. I think that it was a challenge to understand how many more depositors were going to be behind on that Monday, Tuesday, the 13th and 14th of March. So the reality is the regulators had little patience after seeing Silicon Valley fail the previous Friday.
Right.
So Signature was a surprise, but at the end of the day, there may have been more depositors lined up than we realized behind the scenes.
I don't want to dwell on this because I just think it's theater and soap opera, and that's not the purpose of the show. But there is a large part of America that would suggest the senator from the Commonwealth of Massachusetts is onto something here, that the suits and ties should return the bonuses. Should they?
Well, in my opinion, the bonuses were made in 2022 and 2021 for just normal business. I think that there could be some penalty for the lack of contingency planning for liquidity. You know, banks are levered 12 to 1, and they just did not fathom that they would see these big concentrated deposits all walk out at the same time. And that, I think, was the mistake made. And there's too many securities invested and too, longer term duration assets on the books. At the end of the day, I think that it was a mistake on many fronts, including the regulators. So I think there's a little bit of blame to go around everywhere.
Chris, I'm looking right now at Western Alliance shares at more than 11% in pre-market trading as people get a sense that deposits are coming in the door. They're reporting this now on a weekly basis because it's good news. PacWest shares also up about 11%. I understand that off a very low base, but still, do you think that this is right, that deposit strength in one bank really suggests a stabilization in the entire regime?
I think that's accurate. I mean, we have seen much more stable deposit flows from the weekly Fed data all throughout this saga since March. So deposits are down 4.5% year to date. We're down 6.5% from the peak in 2022. The reality is we're normalizing in terms of deposits and funding mix in the industry. I don't really see big disintermediation. It's only a short-term indicator that money market funds are up and deposits are down. We still have deposits, 28, 29% higher today than they were at the end of 2019. I think there's the opportunity for deposits that left at PacWest and left Western Alliance to come back. I think the market's trying to ascertain that, and I think there are positive days ahead for both of those companies.
Let's say things have stabilized, Chris. You talk about the pretty massive distortion that occurred when you did see all of these deposits, I think trillions of dollars, flood into the system all at once. There is a question of where those deposits were deployed. Was it commercial real estate? Was it loans to companies that might be faltering at this point? How much, even if there is stabilization, there is still a very big problem on the books of some of these regional banks?
So we really saw loans grow very little in 2020 and 2021. It was only in 22 that loans started to grow. And a lot of the growth came in mortgages. It came in C&I loans. It did come in commercial real estate, but I think it's been very muted in terms of the pace of growth in the past year. So we've seen overall loans up about 17% during this time frame and beginning to use the deposits. What I find really interesting is that loan to deposit ratios are 71% today for the industry, up from 60 at the bottom, and that compares to a long-term average since the early 70s of 82%. And we were, I think, around 76, 77 prior to the pandemic. So we're still coming back. I don't think the leverage in the industry is anywhere near where it used to be.
Chris, sell side buy, outperform, single best buy, whatever the ballet is up 20, up 30%. You basically have a double or more than double on some of these selected banks right now. They're going to go into this year, next year, and the following year. Am I right? Is smaller institutions describe how their share price does a double off a bank that's going to be smaller than it was in 2019?
Sure. So it starts, Tom, at tangible book value. So if you look at tangible book, it's $17 to $18 a PacWest. That company is trading at a woeful price to book today. It can come back. We think book is actually going to rise with retained earnings. So that ratio comes off of the 25, 30% level and heads towards 50 and then eventually 60 and 70. And Western Alliance is a slightly higher stock, but still at a discount to book by a pretty meaningful way. And that's why we think it can come back as well. This mirrors 2009 when you had stocks like Fifth Third and the old SunTrust and Huntington Bank that are trading less than 50% of book. And then they end up raising capital for TARP at a higher level, and then they traded much higher at the end of 2009. So, we've seen this movie before. The volatility is very high today, but it does work both ways. And we think back slightly, It's not going to resolve itself all the way because the Fed hasn't lowered rates yet, but it is getting better each quarter.
Are they going to be smaller institutions, or do they grow at some factor of American nominal GDP?
Sure. So for the PacWest and Western Alliances, I think that they will shrink somewhat because the deposits are lower than they were at the end of March and certainly at the end of 2022. For the rest of the banks, I think you're going to see them more flat to growing at about 1%. I think that if we have a recession and GDP contracts, obviously, I think you will see a little bit of contraction, but I think it's very modest. The liquidity in the industry is very high, and it's better today than it was when this began in March. So I think the banks are in a really good spot, and I think there's still credit demand. And inflation tends to be good for business because customers need to borrow more as they have a higher price level for their goods and services.
That said, Chris, I do wonder, especially if you say you'd put some of the blame with the regulators, that they perhaps, and I'm extrapolating here, I'm putting words in your mouth, so please feel free to correct me, they didn't stress test against a massive rise in rates to the same degree that a lot of people said that they should have. There is a question of whether you're going to see this delineation between the PNCs of the world, the U.S. banks, the regions banks, the larger, the sort of mid-size, mid-sized banks, really move away from some of the others and leave the others in a bit more world of hurt.
I disagree with that because I think there's lending opportunities all across the spectrum, from community banks that serve their customers really well and are a key piece of the puzzle for giving advice. I think as you move up to mid-size and larger companies, they can do the same. All of these banks have good capital and good reserves. I think they could use more as we go through the cycle. I think some banks will raise capital to kind of create a sign of confidence, perhaps fill in the bucket from the unrealized security losses. But I think that can be done from a position of strength. It doesn't have to be forced on these companies today. But I think you're still going to see them lend and still see them expand. And they're going to be ultra conservative. There's no question that there's a credit crunch today. I just think it's going to be a more measured approach. And overall, leverage in the industry is very low today.
Christopher Marinac, thank you so much, and thank you for the many appearances through this crisis. He's with Janney Montgomery. Scott, I don't know, Lisa, is it still a crisis? I mean, can we go all clear on the banks? I'm not there mentally.
Well, people seem to be less interested in the banks, which I guess is a good sign, right?
Yeah,
I mean, there seems to be a lot less focus on what's going on. The debt ceiling discussion today, I thought, was really interesting, that perhaps the biggest risk is that we do get some sort of deal by the weekend, and that seems like it's more plausible based on some of the optimistic language that we've heard. At least that's the assessment by analysts who know well more than I.
I mean, the micro, we barely mentioned it today, but on PacWest closing ugly yesterday, $4.57. It's got a lift to 508, 509 right now. I guess that's, moving in the right direction. I do agree with you that through this odd week with so many different trends, the debt ceiling trend on this Wednesday is different than it was on Monday. It's a more conducive story.
And the retail story is perhaps disappointing on the headline level, but underneath you could still feel some resilience in pockets, even of consumer discretionary spending. So again, not a lot of clarity, but still resilience.
Claims tomorrow for all of us, and then on Friday we will have Anne-Marie Horton reporting on the president's travels in Japan and at Hiroshima as well. Futures up 17, the VIX constructive 17.51. In the 10 o'clock hour, the former vice chairman of the Federal Reserve System, Richard Clarida. This is Bloomberg. Good morning.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, Should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So a dollar there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Live from New York City this morning. Good morning, good morning. Equity futures just starting to turn a little bit higher going into the opening bell. Equity futures positive 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, debt limit talks intensifying as Biden heads to Japan. Banks catching a break as deposits rise at Western Alliance. And Fed officials revealing the debate over June. We begin with the big issue. The Fed Speak Marathon continues. New York Fed President John Williams declaring, we've got to make our decisions and then watch what happens. Get that feedback. See how the economy's behaving. President Barkin agrees to some extent. I do want to learn more about what's happening with all these lagged effects, but I also want to reduce inflation. If more increases are necessary, I'm comfortable doing that. President Mester throwing in some hawkish notes for good measure. Given how stubborn inflation has been, I can't say that I'm at a level where it's equally probable that the next move could be an increase or a decrease. If that isn't enough Fed speak for you, before the week is out, you'll hear from Jefferson, Barr, Logan, Williams, Bauman, and Powell, and maybe even others too. And when you listen to these Fed speakers, if you can endure it, consider this. As BNY's Alicia Levine indicated this morning, most Fed officials are doing their best to pretend June may still be a live meeting. What if it is? Citi's Andrew Hollenhorst expecting a hike next month, saying this. Activity data for April, including solid retail sales and industrial production, suggests growth may accelerate in Q2, rather than slow as the Fed intends. Also inconsistent with the slowdown, housing activity is bouncing back from low levels. Joining us now to discuss, Nuveen, Sarah Malik, Matt Miskin of John Hancock Investments. Sarah, first to you. Is June a live meeting?
I think the Fed was likely one and done in May. They're focusing on two areas, and that's the economy and inflation, just with economic data that we've gotten this week. Empire Manufacturing looking very weak. Is that the canary in the coal mine? We're going to be watching the Philly Fed data later this week and what that means for ISM. Empire Manufacturing does tend to be a volatile number. Now, going to inflation, I think that's where the issue is going to be for the Fed. It's still looking very sticky. It's far from their 2% target. We just saw retail sales yesterday. Consumers are still spending. So at most, we're going to get a pause from the Fed, but we're not pricing in a pivot to rate cuts like the market is later this year. We think we get a long, elongated pause from the Fed and high rates until inflation gets closer to that 2% target.
Matt Miskin, just getting a headline across the Bloomberg terminal that JP Morgan's Jamie Dimon and other bank CEOs together are meeting with Chuck Schumer, the Senate Majority Leader, on the debt limit. Now, if we can deal with the debt limit, do you think, Matt Miskin, that opens the door to a move in the middle of June, 4 weeks today?
Yeah, we think that they're going to stay on hold. The lagged impacts of monetary policy are going to really show up over the summer, in our view. That's really when the 75 basis points hikes of last year started. So that's going to come in. We think they're going to pause. But what's right now, the dynamic that's playing out is because the two-year yields bounced, is actually that the September rate cut is being priced out. So that's more likely to see near term. But watch the dollar here, because regardless, the dollar's starting to get a bid. And that actually would be a huge rug pull for the consensus right now. If even any tighter monetary policy is priced in right now, the dollar gets a bid, and that's a rotation in markets that hasn't happened year to date.
Matt, I'm with you. That's a geographic rotation as well. The data turning the other way in Europe, over in China too. Do you think that pushes back against that narrative, that consensus view that the rest of the world starts to outperform, continues to outperform through the rest of this year?
100%. The economic surprise index has been declining globally, and especially in the Eurozone. So economic data coming in below estimates. Before it was just, hey, Eurozone's not in a recession. That's bullish. 0.1% GDP growth in Q1, and European equities are the best performers globally. I didn't think I was going to see that to start this year, but nonetheless, that's what's happened. But what we've seen is that the economic data, because expectations are now coming up, the data is coming in below that. And you're starting to see a weakness in the euro here as of late. And that's a key dynamic that could change the underlying dynamics of this market.
The euro right now, 108.29, that currency pair negative 0.3%. Matt, as you've indicated a few times when we've caught up, look out copper, look out below. New lows for the year on copper. Weaker data out of Germany, weaker data out of China. You put it all together, Sarah, do you think we're starting to price in maybe some weaker growth just beyond the index level story beneath the surface of the S&P 500?
I think the S&P is still pricing in a soft landing. We're above 4,100. I think valuations are very optimistic. And what we do have in front of us is that consumer credit cycle, because banking lending standards are likely to tighten. We also, even though we came off a strong first quarter of earnings, comps are tough for earnings going forward, and companies' reports are very much dependent on pricing power within their revenues. They're already seeing margin contraction. I'm worried about pricing power going forward. As inflation does start to moderate, it's going to be tough for companies to hold on to their pricing. Just look at Target today, a softer outlook based on the consumer. We like companies such as Costco, where the consumer likely trades down. They take market share. You may get a special dividend out of Costco, which would be a positive. And they haven't raised subscription prices in 6 years, so they're due actually for a price increase. So we're looking for companies such as those, which can be more resilient in what we do think is a likely economic slowdown. And as I mentioned, market valuations are pretty frothy given that the economy is likely to slow.
Sarah, let's build on that. Chuck Crom yesterday of Gordon Haskett joined us on Bloomberg Surveillance following the Home Depot results, and he said what we face now, his words, his phrase, a discretionary recession in the goods sector. We've seen signs of that over the last 12 months. Do you see more signs of that?
We are seeing signs of weakness with the consumer. They're dipping into their savings rates to spend, but however, they are still spending. I think going forward, the consumer will likely weaken. It's going to be dependent, though, on the employment market. As long as people feel comfortable in their jobs, they're likely to keep spending. You're seeing with claims starting to drift up, employment is starting to show cracks. But the employment market is not rolling over yet, and that's likely also back to the Fed, what they need to wait to see before they start putting in rate cuts. So employment and consumer still fairly resilient. It's basically a slow crawl to a recession at this point. I think that's why the market's not completely pricing that in. As we know, this week, the market's just very focused on the debt ceiling and the outcome there.
Matt, as you know, we've seen some weakness in goods. We haven't seen much weakness in services. Through the pandemic, that goods demand was pulled forward. That services demand was pushed out. We're experiencing that service demand now almost exclusively through airlines. For anyone who's been to an airport recently, they're living that. I just wonder, Matt, how long before it spreads from goods to services? And I think that's a big, important question for this FOMC as well.
Yeah, it's one of these behavioral finance traps where you go to the local nursery the day before Mother's Day and it's booming. You just hear the cash register going off. And yeah, you go to the airports and you see all these people and you think, wow, we can't be in a recession. But at the end of the day, it's about where we were on the comps. And the fact is a year ago, just over a year ago, we spent $5 trillion of economic stimulus. And from now on, it's going to be hard to beat that peak earnings rate, that peak activity in this economy. And we believe we're past peak earnings as a result. And it's going to be a downtrend. It's a slow one, as Sarah has said. And I think that's spot on, that basically it's a slow moving deceleration. But with the Fed raising rates, and even if they're just holding right now, that's going to be incredibly restrictive as the year goes on, as there's deterioration in the economy. So for us, again, it's about playing defense across the portfolio. We think this backup in bond yields, this rise in bond yields is going to be actually an opportunity, a gift in essence, to reallocate more into high quality fixed income, move more to intermediate duration as the year goes on.
23 minutes away from the opening bound, call it 22 minutes away from the opening bound right now. Your equity market is positive by 0.4%. I mentioned that Fed Speak Marathon. I went through those names for you for the week ahead. Jefferson, Barr, Logan, Williams, Bowman, Powell, perhaps others as well. Mike McKee has caught up with a few of these names. Mike McKee joins us right now. Mike, what have you learned over the last couple of days?
Well, John, I'm in an airport right now, and so I can tell you that, yes, travel is still booming. The service economy is still growing. And then you take a look at what happened this morning with housing starts. Housing starts go up 2.2%. And the thing that's remarkable is how steady they have been despite the rise in mortgage rates. So the Fed is looking at this, and they're looking at the fact that unemployment is 3.4%. And they're saying, have we done enough? And that's the key question coming up for June. They're pushing back on the idea that we're not going to, that they are going to necessarily pause because they want to see some improvement. The Atlanta Fed has an underlying inflation index where they keep track of all the various inflation monitors. And as you can see, many of them are doing worse than they were a year ago at this time. So if inflation is still sticky and the economy is still strong, is 5.25% enough? And the thing we learned from this conference that we were at is that they don't really want to take a position yet. You can see there are some who are saying, well, we lean towards a pause, but more are still worried of those who have spoken out lately. And the whole group is saying we're not going to make a decision until we get to June 14th because we don't want to stop too soon if inflation is still sticky.
Mike McKee in a busy airport, right on cue. Appreciate it, Mike. Looking forward to having you back in the studio in a couple of days' time. Ahead of that Fed speak, let's talk about sector preferences right now with this in mind. If things are starting to re-accelerate, maybe you push back against that view, but let's go with it for now. What does that mean for the outlook for interest rates? And what does it mean for the sector preferences at the moment? Going back to the Bank of America Fund Manager Survey, the global survey that came out yesterday morning, long big tech, #1 most crowded trade. #2, short bank. Sarah Malik, any reason whatsoever in your mind to push back against any of that? That long bank, long big tech view, short US banks?
We came into this year positive on technology, and we've been cautious on banks for a long time, not just because of the mini banking crisis, but because significant increases in interest rates leads to net interest margin pressure for banks, which is what we're seeing. And now after the crisis, tighter liquidity, tighter capital requirements, I don't think the outlook for the banks is great. And also banking's all about confidence. So this domino effect of bank to bank, having bank runs could continue. It's very easy these days, pick up your phone, move your money. So I think banks still have issues going forward. Technology looks positive to us. Coming into this year, software tends to be more resilient to an economic slowdown. They don't rely on pricing power. They have strong backlogs and good revenue visibility going forward. And then semiconductors came into the year strong. I think they take a breather, but we are going to see the bottom of that cycle. Normally, semis bottom after 6 to 9 months. It's been a little bit more than that. I think that bottom hits, and then semiconductors look positive again. Those are the two areas of tech that we like.
Matt, are you on the same page?
100%. Well done, Sarah. That's exactly what we were, positioning-wise, similar story coming into the end of the year. But what I think is fascinating about these surveys is just what macro regime does technology and Eurozone equities work at the same time. So Eurozone, #1 sector, financials, which is actually the biggest one of those underweights in that fund manager survey. And then technology loves low inflation, low growth, longer duration asset. Eurozone is going to be more cyclical, more industrials, more financials. So there isn't even a macro regime where all this could line up. And the only thing that tech and Eurozone equities have in common right now, they're both year-to-date winners. So basically what that Fed manager survey is telling you is there's a lot of trend following right now. And you're seeing these momentums in pockets of markets. But again, we're trying not to chase our tail in some of these, rotations within these surveys, focusing on high quality companies, better balance sheets, higher ROE. And part of that's technology. It's not
Matt,
going
I
to bring
sense from you that you think that's a bit of a disconnect that needs to break, needs to reconcile. Is that right?
100%. Yeah, exactly. You gotta, eventually the macro regime is going to dictate where we are in the cycle, what the leadership's gonna look like. And right now, because we're just in this choppy range, we're getting this disparate, parts of the market that are working, and then you're getting trend following into it. And we think that you're going to just end up chasing your tail, like I said, and we really want to be disciplined and focus on the fundamentals.
Matt Miskin, Sarah Malik, sticking with us about 17 minutes away from the opening bell. Equities positive by almost 0.5% on the S&P 500, with some movers going into the open. Here's Abby.
Never a dull day, John, especially for the regional banks. Taking a look at the shares of PacWest and Western Alliance, we are seeing a big rally, up more than 10% the last time I looked. PacWest now up 9%, Western Alliance up 11%. And this, of course, is Western Alliance reports that the second quarter deposits so far have grown by $2 billion. So the run on cash that we've seen in some of these banks not happening there, really shoring up confidence. As for Tesla, some confidence shored up there too after the annual shareholder meeting. The company will be trying advertising. Elon Musk indicated the next 12 months could be difficult on the bank turmoil. And for those Cybertruck fans out there, well, it will be unveiled and available this year. NVIDIA up 1.3%, yields down, big tech higher. And then finally, Target up 1.4%. It's interesting, we do, of course, have them taking the second quarter adjusted EPS guide below the estimate, but John, they're holding on the year, and investors seem to be sticking with that longer-term view that they will manage everything that's going on with the economy and slowing consumers and discretionary spending.
Abby, thanks for that. Coming up, everybody playing nice in Washington.
We just finished another good, productive meeting with our congressional leadership about a path forward to make sure that America does not default on its debt.
Debt ceiling talks intensifying just as the president heads to the G7 in Japan.
Top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
We just finished another good, productive meeting with our congressional leadership about a path forward to make sure that America does not default on its debt for the first time. I made it clear to the Speaker and others that we'll speak regularly over the next several days, and the staff's going to continue meeting daily to make sure we do not default.
Soothing words coming out of the latest high-level debt ceiling negotiations. The president saying talks were good, they were productive. There is an overwhelming consensus that default is not an option, and staff will meet daily to ensure that's the case. That constructive tone echoed by Speaker McCarthy.
It is possible to get a deal by the end of the week. It's not that difficult to get to an agreement.
Senate Majority Leader Chuck Schumer weighing in with some words of encouragement as well.
It was a much more cordial meeting. There were honest and real discussions about differences that we have on a whole variety of issues, but it was all respectful.
Debt ceiling talks between the White House and congressional aid set to intensify from here as negotiators seek a framework agreement for the president to review upon his return from the G7 meeting in Japan. Joining us now from D.C. is Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, the mood music certainly seems to be better this morning. Really two tangible things coming out of that meeting yesterday. One, consensus that the U.S. will not be defaulting on its debt. And two, the group of people negotiating has gotten smaller. Kevin McCarthy effectively successfully cutting Schumer and Jeffries out of these talks. It is now Team White House talking with Team Speaker. On the Speaker's side, Congressman Garrett Graves will be representing his interests, while Shalanda Young and Steve Ricchetti from the White House will be handling the administration's view on things. But they still have their work cut out for them to reach some kind of ironing out of a compromise by the time the president returns on Sunday from his trip abroad, John. Speaker McCarthy, despite his more optimistic tone yesterday, did say the two sides are still far apart. Now, we understand permitting reform, COVID funding, spending caps may be areas of middle ground, but the issue of stricter work requirements for entitlements may be a sticking point. I spoke with Democrats on both the House and Senate side yesterday, Elizabeth Warren and Haley Stevens, who said they would not vote for a package that included those measures, and yet Speaker McCarthy has described that as a red line. So there still is a lot of work to do to reach a compromise, and the clock is working against the negotiators here, John. By the time the president returns on Sunday, we'll just be 11 days out from June 1st and bumping up against the Memorial Day holiday as well. And remember, any deal agreed to still has to work its way through Congress and then to the president's desk. So the pressure is on, and I would note that Democratic leadership is trying to amplify that pressure today. At 11 a.m. Eastern time, Senate Majority Leader Chuck Schumer will be meeting with bank executives, including J.P. Morgan's Jamie Dimon and Citi's Jane Fraser, really trying to put pressure on them to put pressure on Republicans to avoid a default because of what they all say are drastic economic consequences if that happens, John.
Kaylee, thanks for that. And the process that Kaylee described, the second piece of it might be the hardest piece of it. They can agree to a framework, agree to something. Getting it through the House, through Congress is a difficult thing, a different thing altogether. Sarah Malik, Matt Miskin with us for a final word. Sarah, the president quipped yesterday, we're having a wonderful time. Things are going well. Are you having a wonderful time following this?
Well, markets are going to stay hyper-focused on the debt ceiling until we come to a resolution. I see three potential outcomes. One is a full-fledged resolution, which would be very positive for the markets. Second is we breach the debt ceiling. That's likely 10+% downside for the markets. And third and most likely is we come up with a short-term solution, kick the can down the road until the fall. That would be mildly positive for the markets. My bigger issue, though, is the reforms on austerity with this deal, and what does that mean for the economy going forward? We're already dealing with an economy that's slowing. If spending is cut back from here because of this resolution, I think that just increases the chances of a mild recession.
We know to some degree the market has picked up on the tension in very specific isolated parts of the bond market, Matt Miskin, in T-bills, these so-called at-risk maturities. If we got an agreement, and let's say, Matt, we get an agreement, it goes through Congress, the relief rally, where would you expect the relief to be beyond those at-risk maturities?
You know, it's hard to say because right now I'm not seeing much of this priced in terms of risk. Usually when this does get really ugly, you see treasury yields fall, you see risk off, you see equities fall, we just haven't seen it. So I don't know if there is much of a rotation. I think actually not much risk is priced into this market to begin with. The VIX is low, high yield spreads are tight. So I don't see much of a relief rally per se. I think we're still just kind of in this choppiness. The debt ceiling has been passed nearly 90 times throughout the course of the history of the United States. So this is the playbook. And it's just like you said earlier. I mean, the most likely outcome is that they're going to punt. We're going to get an American punter to come out here and, you know, we're going to punt it down the road and we're going to cheer for that. And then we're going to have to relive this all over again. And I just think this is unfortunately the way it works. But if you let this kind of development politics go into your portfolios over those 90 times, you would have made massive mistakes as an investor. Don't focus on this, is all I'm trying to say, and really just focus on, the asset classes you think are going to provide better return potential. We think there's pockets of the equity market. We think the bond market, especially right now, looks like a compelling opportunity.
Matt, is this something you can afford to ignore?
We think that if you played out every black swan and you just focused on that as your investment, process, I think you're going to really miss out on opportunities over the long term. And this, again, we've done this over and over again. It's not something this is new to the market. So again, we would focus on other things and the economy and all these other things we're talking about in terms of macro. It is a risk, but I don't think it's much priced in, and we'll see how it goes.
You're not alone. You're in company. Matt Miskin, Sarah Malik, the two of you, just brilliant going into the opening bout. A lot of people, most people, taking that view that this will get down with, which is why this equity market is barely moving, and why some people also think that if this market doesn't show much of a reaction, that maybe the urgency in Washington will be lacking. Do we need a crisis, or at least get close to a crisis to get a solution? That remains to be seen. Libby Cantrell of PIMCO actually pushing back against that view. Your equity market right now, 7 minutes out from the opening bout, positive by 0.45% on the S&P. Coming up the morning calls in later, Peter Cecchini of Exonic on why non-bank lenders are ready to pick up the pieces. That conversation about 7 minutes away.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Minutes away from the opening bell. Equity futures just about positive by 0.5%. That's the price action. Let's get you some morning calls. First up, Barclays upgrading Wynn Resorts to overweight, seeing resilient demand out of Las Vegas and strengthening Macau bookings. That stock is up by 3%. Evercore upgrading Norfolk Southern to outperform, noting the company's quality business model and the stock's attractive valuation. That stock is up by 1.7%. And finally, Credit Suisse downgrading Werner to neutral, growing increasingly cautious on the trucking cycle due to lingering macro headwinds. That stock is down by about 2%. Coming up, Target topping Q1 estimates, but delivering a softer outlook as consumers turn more cautious. That stock just slightly softer in early trading. Up next, we'll get Peter Cecchini at Exonic to weigh in. About 4 minutes out from the opening bout. Equity futures positive. Your opening bout up next.
life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
From New York City,
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
Live from New York City this morning. Good morning to you. Equity futures positive, a bounce after closing at the lows of the session in yesterday's session. A bounce on the Nasdaq 2 up by 0.3% on the Nasdaq 100. The data out of the United States better. Retail sales resilient. Industrial production decent. Is housing starting to re-accelerate? Is that continuing? We'll keep an eye on that. There's your opening bounce. Switch to the board and get to the bond market. In the bond market, the focus on Diamond, on Fraser. Bank CEOs meeting with Chuck Schumer. Congressional leadership want to talk about the debt ceiling. No one in this market wants to discuss the debt ceiling. Your 10-year, 352.45, yields unchanged there. The dollar, off the back of that data, showing some strength. Euro dollar, 108.31, negative 0.3%, and crude reclaims 72 on WTI. Positive on the day by 1.7%. This market positive on the day as well. About 27 seconds into the session, up by almost 0.5% on the S&P, up by almost 0.4% on the Nasdaq. One stock to watch at the open is Target, the retailer topping Q1 estimates, but providing a downbeat outlook due to, quote, softening sales trends. Bloomberg's Simone Foxman joins us now with more. Hey, Simone.
Hey, John. Yeah, traders are processing strong first quarter earnings, keeping its growth outlook for the year, but at the same time talking about a soft consumer outlook for the year as well. And we just finished the earnings call there, so that could explain some of the volatility we've seen over the last couple of seconds. Strong spending growth on food and beverage, on household essentials, but falling on apparel and accessories, and food and beverage, not as high margins as some of the cooler stuff. But at the same time, TJ Maxx, that is the place that many analysts think that a lot of consumers are going to spend on discount stores like TJ Maxx and Marshalls. We didn't see quite the earnings that analysts had expected, but seeing more foot traffic at both of those stores. Roughly this falling in line, I think, this consumer story with what we heard out of Home Depot yesterday. Watch for Walmart tomorrow.
Walmart tomorrow. We'll pick up on that story with you, Simone, tomorrow morning. Target right now negative by 0.6%. TJX barely moving, positive by about 0.5% right now. Let's turn to the financials. Big moves from Western Alliance, leading the regional banks higher after reporting a rise in deposits. That stock is up by more than 10%. Abby has more. Hey, Abby.
Hey, John, and it's unbelievable. Really not a picture of stability. Over the last, I'm looking down at the Bloomberg, the HCP, the historical price with percentage change function, and we're looking at a gain of 10% today, 12% the other day, 4 up days in a row. The longest winning streak for this stock, up 31% over those 4 days since early January. There's also a quick increase of 49%. There's a decline of 38%, a decline of 15%. This is the turmoil that we've had in the regional banks recently. It's not just Western Alliance, but the reason we have the rally right now, it has everything to do with the fact that they are saying that their deposits for this quarter, since the turmoil, the last quarter ended, $2 billion in deposits. The last time they gave a check, it was $1.8 billion. So it's trending in the right direction. In addition, the number of insured deposits has grown to 79% from 68% at the end of the first quarter. So some of the fundamentals for at least Western Alliance improving, taking PacWest along with it for the ride. We'll be looking for those deposit numbers. A crisis in confidence. It seems as though some confidence right now, John, is at least returning to this market for the regional banks. But again, lots of volatility. So let's see what the future brings.
It's a tough effort and difficult to call. Abby, thanks for that. Just trying to restore that confidence in this name. Western Alliance right now, 35.13, positive 11% on the session on the year. Year to date, still negative 41%. Tough year for those banks, many of those banks across that industry. Also looking at Tesla, the CEO, Elon Musk, announcing a major shift in strategy during the company's annual shareholder meeting, saying, quote, "We'll try a little advertising and see how it goes." Ed Ludlow joins us now with more. Morning, Ed.
Yeah, good morning, John. We're up around 0.5%, 0.6% on Tesla. We had been up a bit higher at the open, about a percentage point, muted gains relative to the pre-market activity. Traditionally, Tesla has not done traditional advertising. Elon Musk saying that they will try it in an interview with CNBC. He said that it's a plan that he has only just authorized, and so there is no plan, really. He didn't have much detail on what that would look like, though we recognize that since Elon Musk bought Twitter, the Tesla official account on Twitter has ramped up its activity as one example. The other main takeaways from Tesla's annual general meeting are that J.B. Straubel, the CEO of Redwood Materials, but somebody who was at Tesla for 14 years, was elected to the board. Investors rejected a proposal for a key person risk report, which would require Tesla to publish and maintain an analysis of their bench of talent. The argument that Tesla had made in advising investors to, or shareholders to vote against that, is that it would be putting their top talent in the shop window for competitors. Other than that, a relatively straightforward affair. Elon Musk said that he will now be more focused on Tesla, having found a CEO for Twitter. He wants to lead future efforts when it comes to development of artificial intelligence and has no plans to step down as CEO. Other than that, minimal updates. We did see a video showing some modest progress in Optimus, the AI-powered humanoid robot that Tesla's been working on, John.
Now, Ed, I just want to pick up on something you said about, not the robot, but on the leadership at Twitter. Of the shareholder base, of the people you speak to, do they buy that Elon Musk is going to spend less time at that company and more time at this one?
Actually, it's hard to say whether they buy it or not, because, you know, Elon Musk has traditionally never been a pencil-pushing CEO. Linda Yaccarino clearly has been brought in, to those I've spoken to in the phone in the last 5 days, to bring the advertisers back. Elon Musk has been at the coalface in terms of technological development and literally product development at Twitter. And by moving to CTO and executive chair, there are many that I've spoken to that don't see how that changes. The bigger question is, how does Elon Musk work with Linda Yaccarino? We don't actually have a great deal of insight into how his relationship, for example, works with Gwynne Shotwell, who's president and COO over at SpaceX. My understanding from sources and reporting on that company for a number of years is she basically runs the show, and Elon Musk comes in and makes decisions as and when needed. Seems like he'll still be a lot more hands-on comparatively at Twitter.
Stock is just about positive, as you indicated, Ed. Great to catch up, buddy, as always. That stock is up by 0.6% on Tesla. The broader market right now positive by about 0.5% on the S&P 500. 6 or 7 minutes into the session on the Nasdaq, up by 0.33%. In the bond market, yields pushing a bit higher again at the front end. Yesterday, right the way through the curve, data was better, decent. Fed speak a touch hawkish, Barkin, Mester, others as well. Throw in a chunky Pfizer deal in the bond market too. Yields starting to rise and continuing to climb this morning at the very front end, 4.1%, and starting to see some dollar strength into the mix as well. The euro against the dollar negative by 0.35%, just about holding on to 108. Yesterday, Tony Dwyer came on this program and he talked about the market being fine. Just not what you think that word means. Fine, F, frustrated, I, insecure, N, neurotic, and E, emotional. Peter Cicchini joins us now of Exonic Capital. Peter, would you say this market is frustrated, insecure, neurotic, and emotional?
I wish I'd thought of that. That's really clever. I would. I think, you know, the interesting thing about it is one of the things that's giving people some solace is that the S&P 500 still has a 4 handle on it. But, you know, when you look at the internals, even of the S&P 500, you know, you're looking at an index whose constituents, only 40% of which are above their 50-day moving average. And when you look at something like the NYSE, which is obviously a much broader index, about 40% of those names are above their 200-day moving average. So the internals of the market have been weakening for some time. And I think the neurosis comes from a few things. In particular, you know, you've got 5 or 6 mega tech giants who have been proffering an AI is everything narrative over the past few months, and that's certainly helped their stocks, and their stocks have helped the S&P 500. And again, it's a perceptive issue relative to the index that everyone looks at for sort of you know, an all is well signal.
Pete, one thing that Tony talked about yesterday is about being equally hesitant to get long as you are negative to get short. Peter, would you share some of that?
Yes, certainly. You know, that, and part of that is that the names that have gotten hit the hardest, the banks, for example, even if one was cautious for the prospects of regional banks, it was very difficult to get in front of or to deploy short strategies in front of that sell-off. And it's been sort of a slow train wreck in all those names that are, in fact, trading below their 50-day moving averages. So it hasn't been easy. The next leg might be consumer names, because we certainly are seeing the consumer pull back and trade down. And so that's an interesting spot to look if one wants to get short. But clearly, you know, on a headline on the debt ceiling, markets could be up a couple of %, and you know, you don't want to be on the other side of that, because volatility has just been getting decimated in large cap stocks in particular.
It's super difficult. S&P 500 information technology year to date up 24%. Year to date, KRX regional bank index down almost 30% year to date. Pete, if I could put you on the spot, if you don't mind, and just give me the way you think about this. If you had to get long one right now, information technology or the banks into year end from now, which one would you pick?
That is a great question. You know, I think the banks are going to be challenged from a profitability standpoint for quite some time. Regulators are going to assure that they're taking the proper level of loan loss reserves. So I do not love a long in the regionals, despite the fact that they've been beaten down as much. And large cap tech is wildly overvalued and based on a narrative that does not resonate with me. But that said, if I had to choose, gun to my head, it'd probably be large cap tech.
Pete, let's talk about the banks then, and why it's not the banks. You've mentioned this, other people have talked about it, that the banks are going to have to pull back from traditional lending to some extent in certain places. Pete, can we start there, where you expect that pullback to develop, and if you're seeing signs of it right now?
Yeah, you know, we are. I mean, at Exonic, we do a lot of different things, but, you know, we're an alternative lender in many cases with a private credit fund that will have an opportunity, and we're seeing opportunities already to pick up the slack for where regional banks are pulling back. We're also seeing BWICs on loan books. We're seeing a lot of opportunity to look at loan portfolios that may actually be money good, but the banks just cannot, from a regulatory capital perspective, afford to have on their balance sheets. Regulatory capital relief trades are of that ilk as well. And so, you know, while it's certainly not a very good thing for the U.S. economy, it does present opportunities for alternative lenders and alternative investors like ourselves.
So, Pete, let's build on that. Banks pull back, non-bank lenders step in. Are there parts of the market that non-bank lenders like yourself, Pete, won't step back into? Parts of the economy that might get left behind, might suffer, that perhaps as investors we shouldn't touch for now?
Yes, well, you know, we're fortunate here that we have a very deep real estate expertise that extends from residential real estate all the way into commercial real estate. And from the top of the house, we've made a call here to stay away from office. And we believe there's more pain to come in office. At some point, it will likely present what, you know, we believe to be a generational opportunity No one is good enough or smart enough to know exactly when that presents. But we're certainly poring over opportunities on a regular basis to assess whether or not we're getting closer to a bottom in office. There are other areas that we continue to like. We continue to like housing, frankly. There is a structural shortage of housing, and we buy Freddie Mac B pieces, and that is a workforce housing play. And given that shortage of housing, we think that's a very nice defensive area for folks like us to continue to invest.
Pete, you mentioned housing. Housing starts this morning much better than anticipated. Something that Andrew Hollenhorst, the city, talked about this morning. I'd love your response to before you have to run. I'd love to get your response to this. Activity data for April, including solid retail sales and industrial production, suggests growth may accelerate in Q2 rather than slow. Also inconsistent with the slowdown, housing activity is bouncing back from low levels. Pete, do you see any reason to push back against that?
Yes, I think, a couple data prints do not a trend make. The housing market, we believe, is going to remain a bright spot for some time relative to the rest of the economy. But I think the writing's on the wall relative to the progression towards a likely recession. I mean, if you look at the regional surveys, they are screaming recession. We're already seeing ISMs and PMIs in negative territory for several months. The Michigan survey, and everyone makes fun of how important it's become, but it's also screaming stagflation, with one-year inflation expectations rising, while expectations overall are flagging. And I think there's lots of data that is continuing to trend negatively versus housing.
Hey, Pete, great to get your thoughts, as always. Peter Giacchini there of Exonic, weighing in on a whole range of issues right now. About 14 minutes into the session, your equity market still positive, just about. By 0.4% on the S&P, on the Nasdaq positive by 0.3%. One name we were looking at, Target, positive in early trading by 1.4%. Flagging some softening trends, but ultimately maintaining that outlook, supporting that stock. We had Home Depot disappointing a bit yesterday. Walmart tomorrow. Retail sales overall, the headline number, the control group, to be very specific, better than anticipated, which is why some people like Andrew Hollenhorst, the city, are still talking up the prospect of interest rate hikes in June and perhaps again in July. Coming up on this program, bankers taking a grilling in Washington.
There were a series of events, unprecedented events that occurred that led us to where we are today.
No, this wasn't unprecedented. This was bone deep, down to the marrow, stupid.
It's the turn of the regulators. Up next.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time? Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more.
That's optimistic.
And Joe Matthew.
The debt ceiling
is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Why did you let things get this bad? Why did you ignore admonitions from regulators?
News reports and investors wrongly lumped SVB and Silvergate together.
Becker, you made a really stupid bet that went bad, didn't you?
There were a series of events, unprecedented events that occurred that led us to where we are today.
The laws are not above you. So I'd like to understand why you thought they were.
As we looked at liquidity overall, relative to the size of bank we were, we certainly felt that we had ample liquidity.
Are you planning to return a single nickel to what you cost the fund?
I know there's going to be a process review of compensation.
I'll take that as a no.
Bank executives are taking a grilling on Capitol Hill. Top banking regulators have their turn later today, testifying before the House Financial Services Committee. In addition to failures in management, many have also laid the blame at the feet of supervisors for not doing enough to prevent the failure of 4 U.S. mid-sized financial institutions. Western Alliance catching a break this morning, gaining in early trading and leading U.S. regional banks higher after it indicated deposits have been rising since the end of last quarter. Western Alliance right now is positive by almost 11%. Bloomberg's Nathan Dean joins us now from the DC Bureau for more. Nathan, let's start here. Are you expecting more of the same today?
Yeah, you know, yesterday the Senate Banking Committee put those 3 executives through the ringer. The same thing is going to happen today at the House Financial Services Committee when 50 or so members each get their 5 minutes. And I don't think we're going to learn a lot. It's going to be a lot of political theater, certainly things that we can watch with our popcorn and so forth like that. However, the U.S. banking regulators were testifying up on Capitol Hill at the same time, and we learned 3 things. 1, a proposal that is known as the Basel III Endgame is coming. That's going to lead to higher capital requirements for Bank of America, JP Morgan, Citigroup, probably out June, July. 2, regional banks are going to face a new proposal on enhanced prudential standards, tougher liquidity coverage ratios. This is for banks 100 billion assets and up. This is probably going to be out by this fall. And 3, most surprisingly, the FDIC said they're working on a proposal along with 5 other regulators to essentially restrict or defer incentive compensation and bonuses for bankers. This is a 2011 proposal that they never finalized. So if you're in the C-suite or if you're what is known as a significant risk taker at one of these banks, your bonuses may be impacted in the years to come.
And Nathan, do you sense there is bipartisan support for these initiatives?
So in terms of Congress, no. In terms of the regulatory actions, they can actually bypass Congress. And so you just need agreement on the regulations, or from the regulators. Now, the regulators have brought agreement for those first 2 items, the Basel III Endgame and the Silicon Valley Bank response for regional banks. When it comes to the incentive compensation, I'm not exactly sure they can get there. And the thing to note is that if a proposal is not out by, say, September of this year, they only have a year to finalize it before the 2024 elections. And if they don't, and we have a new president, well, you get a regulatory change in thinking, and these proposals may never see the light of day.
Interesting. Nathan, appreciate the update. Just brilliant. Nathan Dean there of Bloomberg Intelligence on the latest down in Washington, D.C. The broader market, as we anticipate, more of the same down in Washington a little bit later this morning. The broader market looks like this about 22 minutes into the session. Your equity market positive by 0.2% on the S&P, on the Nasdaq just about positive by 0.1. These gains have faded in the last 10 minutes or so. Yields are a bit higher at the front end of the curve by 2 or 3 basis points. The 2-year 4.1%. Let's get you some sector price action. Here's Abby.
Well, John, to your point on that fading moments ago, we had most of the S&P 500 sectors higher. We still have a majority, but not quite as many. Discretionary and financials leading the way, both up 0.8% or more. Just moments ago, we had a few sectors that were up more than 1%. The worst sectors, utilities, staples, and healthcare. So that's a little bit risk on, given the fact that those are defensive sectors. Let's take a bigger look, though, at discretionary and financials, because this year it's uncommon to see both of those higher, because, of course, the discretionary category, many of those stocks are included in the mega cap tech indexes, such as the NASDAQ 100 and the NYSE FANG Plus index on the year. Look at this divergence, John. It's really incredible. It's like a tale of two different worlds in terms of stocks. Tech stocks up 22 to 46%, banks down 26 to 35%. This divergence is interesting, and at one point it will connect. Who knows how, but it could create some fireworks.
What a divergence. What a difference. Abby, thank you. We were talking about that with Peter Cicchini and others this morning. At the index level, super calm, not much movement, almost boring. Beneath the surface, so much is going on in this market. Up next, your trading diary.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
26 minutes into the session, just about positive. Those gains stick in, holding just for now, positive 0.2%. Plenty of action later in the day. Let's get to the trading diary. Things look a little something like this. More bank hearings on the Hill, 10 a.m. Eastern Time. President Biden set to depart for Japan later today. Senate Majority Leader Chuck Schumer meeting with bank CEOs this afternoon. Look out for that. Another round of jobless claims tomorrow morning, plus more retail earnings with Walmart ahead of the opening bell. Chairman Powell rounding out the week by speaking on Friday. That rounds out the morning for us. For me, from New York City, thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
One thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off, get-rich-quick scheme that nearly killed a German soccer team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus, and I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not 0, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing.